Very good morning, everyone. Hope you all must be doing great. So let us start with the next revision for the transfer pricing. So we have already discussed two parts, and I believe that you have watched those parts. Today we'll be completing this transfer pricing, and I would be taking one more lecture with you. There we'll be discussing the question and answer, so that you can feel very confident while attempting the questions of transfer pricing. After that, we'll pick up another chapter. I would like to tell you that this is a 100% English video, and we have a separate channel if you prefer to watch in Hindi. So I've already uploaded the lecture in Hindi. You can, I will give the link also in the description. You can go and check it. Right. So let us start with the next revision, round of revision of transfer pricing. So in the last lecture, quickly recap. In the last lecture, we have done some basic things. The transfer pricing provision starts from section 92. 92 says that if there is an international transaction or specified domestic transaction. What is specified domestic transactions that we will be discussing today? So in case if there is a international transaction or specified domestic transactions, then we will actually have to take into consideration that whether this transaction is happening at ALP or not. So if it is at ALP, then very nice. But if it is not at ALP, then we have to determine the correct ALP, right? And how we determine the correct ALP, it is given by section 92C. How we determine. So we have 5 plus 1 method. Why I'm saying 5 plus 1? So total it is 6, but actually 5 other methods which are absolutely given, and the sixth method is can be any other method that can be prescribed by the department, right? So now let us start with 92CC. This is advanced pricing agreement. Very important topic as far as transfer pricing is concerned. This is quite an important topic. See, what happens is in the last lecture, I was discussing with you that whenever there is a person and he has entered into an international transaction or also specified domestic transaction, although we have not discussed about specified domestic, that will be doing today, but let's say international transaction. So somebody is entering into international transaction, let's say Int Limited India, they are entering into international transaction. So the assessing officer can assess their income, and also assessing officer under section 92C, you don't have to remember the section number, but actually it is 92C subsection 3. The assessing officer can actually determine your ALP, right? Assessing officer can determine your ALP. And let's say, for example, every year you are entering into a similar transactions, again and again, assessing officer can determine your ALP, and it might be different also a little bit, right? Although the method, whichever he is using, he would be using the prescribed method, of course, but still the ALP could be different. And it is quite a cumbersome task that every year he is actually doing our assessment, he is calling for all the records, and it is quite a cumbersome, a hectic task, right? Even the assessing officer is determining, or whether the transfer pricing officer. Do you remember the section number of transfer pricing officer? 92CA. So either the transfer pricing officer is determining the ALP. Now see, if you get into the shoes of the assessee, so it would be very hectic for us that it is quite a cumbersome task. It's actually a headache that every year our ALP is getting determined. So we need some sort of provisions so that it can give us a benefit for a longer period of time. So here we have the provisions of 92CC. 92CC, it says it was introduced in the year, you don't have to remember this year, but just for the background, it was introduced in 2012. That there is a concept, we are bringing a concept where assessee, you can actually approach CBDT, and you can actually tell them that, sir, this is the transaction which I'm going to enter, or I have already entered these transactions. So can you please help me in determining the ALP? Either determine the ALP or determine the method by which, please prescribe the method by which the ALP should be determined, so that the assessing officer or the transfer pricing officer should not actually disturb me. So they brought a section in 2012, 92CC, which is known as Advanced Pricing Agreement. Guys, please don't mug it up. See, the name itself is telling you Advanced pricing agreement. Okay. And shortly we call it what? APA. A Advanced Pricing Agreement, APA. So now today a person can actually approach the CBDT and they can say that, sir, actually I would like to enter into an APA. So what will APA help? Two things. See, APA is actually so the person will have a discussion with the CBDT. There is a separate team, APA team. They will have a discussion with the APA team, and after some consideration, looking into it, whatever is your transaction is, they will give you either the ALP or they will give you the method. That this you have to follow. Okay. Then now once APA is entered, do you think that these small sections 92C, 92C is small in the sense that they are not that strong section, because now APA is a stronger section because we got this particular thing from the higher authority. So these sections will not apply in that case. So assessing officer will not disturb us every year. So once APA is entered, so APA assessing officer has to also follow and the assessee has to follow. So one of the important things that is that APA is binding on whom? APA is binding on the person obviously who has taken the APA and also on the assessing officer. In fact, up to the level of commissioner also. Bosses of the assessing officer is commissioner. So up to the level of commissioner, it is binding. So commissioner cannot say, no, no, no. This APA, we will not actually allow it. We will determine our own ALP. No, they can't say this. So please remember one thing, that APA is binding on the person who has actually entered the APA and also the assessing officer. And in fact, the income tax authority is up to the level of commissioner. It is binding, right? Now, what we have to do is the person who would like to seek APA, he can actually, first of all, he has to give an application. He has to give an application to the Chief Commissioner of Income Tax, or we can say Director General of Income Tax. He has to give an application that, sir, I would like to enter into APA. Please, first he will take a pre-consultation. What is pre-consultation? He will actually ask that whether my case is fit for APA or not, right? So first of all, they will check that whether your case is fit for APA or not. As I tell you practically, see in your study material, if you will read, then it is the first step that you have to first check it out. And you have to learn this only, that first you have to check it out whether my case is fit for APA or not. But I'm telling you that practically, this is an optional step today. This is an optional step today. You can directly apply for the APA also, right? But as of now, we are going with the institute. So first, we will give the pre-consultation. We'll do the pre-consultation filing that whether my case is fit for APA or not. See, if they will say that your case is not fit for the APA, so obviously you can't take APA in that case. But if they approve that yes, your case is fit case for the APA, and we can consider that. So the Chief Commissioner will take into consideration and he will say that, okay, your case is fit for the APA. Then you will give the second step should be, first you will pre-consultation, right? The second step would be, now you will apply. Now you will apply, you will fill up a form that I would like to enter into an APA. And obviously there is a fees also. Obviously there is and it's not a very low fees, it's quite a significant fees. Some 10 lakh, 15 lakh, 20 lakh, I'll tell you. So there is a fees also. So now you have to apply for the APA with the prescribed fees. Now your case would be assigned to the APA team, and the APA team will be calling you, will be taking some documents from you, right? So they will be taking some actually documents from you and they will be deciding your ALP, correct? Now, this ALP, obviously, once it is determined, so it is binding on you as well as on the assessing officer up to the level of commissioner. Then, for how many years, very, very important, for how many years this APA which has been given effect to would be valid? So it can be valid for maximum 5 years. So you can apply for maximum 5 consecutive years, future years, right? So maximum for 5 years, it can be valid. Correct. So now the question could be, sir, can we apply for next 6 years also? No, maximum 5 years. So if it is 6 years, so after 5 years, this APA will actually be expired. And after that, you have to follow the process once again. Now the question is, sir, can we apply the APA for 3 years, 4 years also? Yes. 5 years is maximum. You can apply it for 2, 3, 4, 5 years as the case may be, but not beyond 5, right? So maximum 5 years, it can be applied. Now, obviously with the prescribed fees, then when this, see, this has actually given the benefit to the department also, to the assessee also. Why? Because his ALP is determined. So department will also not waste their time in calculating their ALP again and again every year. So it is a benefit to him. So now the assessees of the opinion, sir, is it possible that can you give me this ALP, whether it is possible that can this APA can be applicable also for the past years which has already expired? The answer is yes. So this provision came in 2014. Again, no need to remember the year, guys, just for your information. So this provision came in 2014 that you can also go for APA for the last years also, for the past years also. This is known as rollback provision. This is known as is it visible now? Right. It is known as rollback provision. You can go for the last years also. So for how many years you can actually go for rollback provisions? It is, guys, 4 years. Sir, can I go for 2 years, 3 years, 4 years also? No, it is exactly 4 years. So either you can go for, see, here for future year, it is maximum 5. So you can go for 2, 3, 4 also, or 5 also. But for past years, for if you are taking a rollback provisions, then you have to, there is a fees also, 5 lakh rupees extra you have to pay over here. But yes, you can go for exactly 4 years, not less than that. So if you want 2 years, 3 years, 4 years, no, you have to go for either for 4 years or no ALP at all, no rollback at all. Understood? But yes, there are few conditions, which is very important for examination, guys. That what are the conditions of rollback provisions? So we'll be doing those conditions also. That what are the conditions of that rollback provisions? And sir, if there is a condition for every year. So let's say, for example, the last year's was, let's say, last year 1, last year 2, last year 3, last year 4. These are the last 4 years. So let's say, for example, last L2 year condition, the conditions of rollback is not satisfied by L2 year. Let's say this year, the condition was not satisfied. So you will not get rollback for this year, right? So it's not your choice. The thing is that you have to apply for 4, but actually, if for any particular year, the conditions are not satisfied, then you will not get the rollback for that year. So in that case, you will get rollback for L1 year, L3 year, L means last. So L1, L3, and L4 year, you will get the provision. So the thing is that, again, I'm repeating, can we go for the past years also? Yes, that concept is known as what? Rollback provision. And for how many years we can go? Sir, it is fixed. You have to go for 4 years or you can't go, right? But let's say, for example, due to any reason, any of those last 4 years, the condition is not satisfied, then you cannot go for that year. Understood? Now I believe that you got a little bit idea of what is advanced pricing agreement is. So the person can actually apply for the advanced pricing agreement. Okay. So it is written over here. Section 92CC, even if you don't remember the section number, that is completely fine. So advanced pricing agreement. So I have just pasted a picture over here. So see, now once you get an APA, you are quite comfortable for at least next 5 years that now your ALP has been decided. Okay. So let us understand APA by dividing into concepts. I have already given you the overview. Let us directly jump into the provisions. Now, guys, this APA came for the advanced, this APA came for the ALP that you can actually use in the transfer pricing provisions for ALP. But what they have done is they have done a very good thing. They have said that, okay, there are some other transactions also apart from international transactions. Apart from international transactions, there can be other transactions also. Like, let's say, for example, this is not the this is actually not the concept of this chapter, but still I'm discussing. It is a concept of non-resident taxation. See, let's say, for example, there is a business connection. Let's say, for example, some foreign company has a PE in India. Some foreign company has a PE in India. And how much would be the income of this PE? Because there is actually, again, various decisions, various litigations that how this PE income would be determined. So for this also now, APA can be taken. So today, APA can be taken for two things. Our point of discussion in this chapter is for ALP or for method of ALP. But second thing also, now APA can also be taken in case of we have a PE which has a business connection. Then also we can take APA to determine the income of that PE, right? So that PE is actually not part of this chapter. I'll be discussing with you in the chapter of non-resident taxation, right? Okay. So this, they are saying that today APA can be entered between CBDT and any person, for any person could be the taxpayer, right? Any person for determination of either ALP, either you can determine your ALP, or you can also determine the method of computing ALP. So APA can give you the ALP also, they can give you the method also. And which method they will give you? Any of those 5+1 method, or they can give those methods with certain variations also to you. So either ALP they will decide, or manner of computation of ALP, they will give you the method that how you should compute the ALP in an international transaction. In an international transaction, very, very important. See, please tell me, guys, transfer pricing provisions. Transfer pricing provisions are applicable on what? Section 92 was saying that transfer pricing provisions are applicable on international transactions as well as specified domestic transaction. Although we have not yet, it's a very, very small topic, just 5 to 10 minutes topic. Specified domestic transaction, we'll be discussing it today. So transfer pricing agreement, transfer pricing provision is applicable on these two, right? But guys, APA is only for international transaction. APA is not for specified domestic transaction. Very, very important point, right? So generally we will see, when I'll be discussing specified domestic transaction, I will tell you that generally all the provisions of transfer pricing are equally applicable to specified domestic transaction. But there are few sections which are not applicable to it, and this is one of them. So section 92CC. So section 92CC, what is 92CC? APA. It is only and only for international transaction. It is not for specified domestic transaction. I believe that you understood this. Okay. Now, guys, if you are liking the video, I would highly request to please like the video also. Please like the video so that it can be reached to other students as well. And if possible, do share the video with your friends or with other groups. Okay. So APA can be entered between CBDT and any person for determination of either ALP or manner of computation of ALP. In an international transaction, APA is not for specified domestic transaction, or it can also be referred. So this is actually not the discussion for this chapter, but yes, today APA can also be for the PE in India to see that how much income is attributable to that PE. So that is actually the concept of non-resident. So we'll be doing it later. Now, ALP can be determined. Now, APA team, they will consult with you. You both will actually discuss with each other, and then you both will actually come to an ALP. Then this ALP can be determined by which method? It can be by any of the methods, right? Any of the 5 method or any other method with certain variations also. So they are saying ALP can be determined by using the method referred to in 92C1. What are those methods? 5+1 method, or using the method provided by the rules with such adjustments or variations. So APA team can actually give you certain method with some variations, with or without variations also, right? So this is how ALP can be determined. Not important from examination perspective. This point is not important for examination perspective, but you should know that ALP will be determined by those methods only, or with little variation. In case APA is entered, please tell me if APA is entered, then whether the assessing officer or the transfer pricing officer will also compute your ALP. No, they will not compute. In that case, section 92C, subsection 3, which is where AO was determining, we have done in the last part, where AO was determining your ALP, or TPO 92CA, where TPO was determining your ALP, that will not apply. So it says that in case APA is entered, then 92C and 92CA shall not apply. What is 92C? I have written it over here. That is determination of ALP by AO. What is 92CA? TPO. So those people, because they are actually, I would say they are actually not that big offices, right? So in fact, your ALP is determined by the higher authorities. So obviously they can't deny it. Now, APA is actually valid for how many years? Maximum you can take it for 5 consecutive years. So APA is applicable for maximum 5 consecutive years. Can we take the APA for the past years also? That's called rollback. We'll be discussing that. The answer is yes. Rollback is for how many years? maximum 4 or exact 4. It would be exact 4. But yes, the thing is that if one of the year is the condition is not satisfied, then we can't take it. But it is for actually 4 years. APA shall be binding on APA. Once you have taken the APA, it would be binding on the person who has entered the APA plus the income tax authorities up to the level of commissioner or principal principal commissioner. The person who entered into the APA, it is binding on him. So for you, on you, assessee, it would be binding, and also on the income tax authority up to the level of commissioner of income tax or principal commissioner, we can say, up to the level of commissioner or principal commissioner of income tax, right? But please tell me, let's say, for example, you have entered into an APA. It's a very logical thing. Let's say you have entered into an APA. And for example, the APA team is a CBDT team. APA team and the assessee has entered into an APA. Why? Because assessee has shown that these are the types of transactions which I am entering. So they have determined your ALP or they have determined the method. But please tell me if subsequently, let's say you have taken the APA for 5 years. Let's say after 3 years, the facts of the transactions got changed. Earlier, actually, you were dealing with your associated enterprises and you were selling only product A. Now you are actually giving them product B also, or you are giving them some other services also. So please tell me, can we take the same ALP? The answer is no. So if there is any subsequent change in any law or any fact, then your APA will not be valid now. Because now why? Because actually the base has got changed. The base on which you have taken the ALP, that got changed. So you can't actually go with the same APA. So if it is saying in case of subsequent change, I'm so sorry guys, I'm so sorry. In case of subsequent change in law or facts, if the facts or the law has changed, so APA shall not be binding. Got it? So now APA shall not be binding. Okay. Guys, one more thing. Let's say this is the taxpayer, and they both, taxpayer and the APA team, they consulted each other and they defined this ALP. They have given this ALP, right? So they have taken so many information. What APA team has done, they might have taken so many information from the taxpayer. Tell me, and they have given this APA. Then they have given this APA. Let's say for 5 years, total 5 years, they have given the APA, right? Very, very logical point. And in fact, nothing to mug it up. It's very easy. Just understand it, conceptually understand it. 5 years, this APA was given to you. After 2 years, they found out. After 2 years, the department found out. Oh, already 2 years has passed. 3 years more to go. This APA is ongoing. After 2 years, they came to know, array, this taxpayer has actually given wrong information. He misrepresented it. Suppression of he suppressed some of the information. That is by way of fraud. By way of fraud, by way of willful suppression of facts, this APA has been obtained. So what they will do? They will immediately, what they will do? They will declare this APA as void. And void from where? Void from here or void from very beginning? Void from very beginning. It would be void ab initio. So even on this 2 years, this ALP will not be applied. Why? Because it was by way of fraud. So not only the next 3 years, but the 2 years also which has been passed. So it will be assumed as if that APA was never entered into. And whatever we have determined of last 2 years, it would be an incorrect ALP. Then also these will be also assessed or reassessed by the assessing officer. And let's say if the time limit has expired, let's say for example, if the assessment time limit has expired, doesn't matter. Whatever the days are wasted, whatever the days are actually wasted from the time when the APA has been signed till the time it is declared void, we will give you those extra. We will extend those periods. In all the provisions of the Income Tax Act, it will be extended. Got it? So it's very easy, logical now. So if APA has been obtained by way of fraud, misrepresentation of fact, then the CBDT may declare an APA to be void ab initio. It would be declared as a void ab initio, and from very beginning, we will cancel this APA. And what will the effect? that we will assume as if this APA was never there. And all your assessment, reassessment will happen. And if there is any time limit which has expired, doesn't matter. We will give you whatever the time has been wasted. We will give you all these time limits will be increased by that the amount of time which has been wasted. So consequences of declaration of APA as void ab initio. What would be the consequences? The first thing, provision of the act shall apply as if APA had never been entered into. Like that we have never entered into an APA, we will follow this, that there was no APA. And whatever the time was wasted, we will add in all the time limits of the Income Tax Act, any provision, let it be 153 or any other time limit, we will increase it. Period from the date of APA signed. The day when the APA was signed. See, what was the time wasted? The day when the APA came into effect till the time when the APA was declared void. This is the time that we will give you extra time. So period from the date of APA signed till the date of order of declaring the APA as void ab initio, we will give you extra time, shall be excluded. So this time will be excluded and we will give you extra time to it for the purpose of any time limit under this act. For the purpose of any, for assessment, reassessment, any time limit, we will increase it. Understood? Correct? Now let's say if everything is good enough. So what is the procedure, guys? What is the procedure I have told you? That how you will apply for APA? First, you will give them an application that whether my case is fit for APA or not. So what you will do? A pre-filing consultation. A pre-filing consultation, although practically it is optional, but you have to write that yes. First, we will give this step. So first, apply for pre-consultation filing. If your pre-consultation filing gets approved, then give the application for APA with the prescribed fees. Okay. So first of all, you will compliance procedure. First of all, application to Director General of Income Tax, Principal Commissioner, Principal Chief Commissioner. Application to Director General of Income Tax, International Taxation, requesting for pre-filing consultation. What is this? You don't have to remember the form number, guys. You don't have to remember the form number, not required. Any of the form number, you don't have to remember. Okay. First of all, we will give them application, sir, whether my case is fit for APA or not. If they say yes, very good. Apply for the APA then with the fee. If they say no, then you can't get APA. Okay. Let's say if they say yes. Person treated eligible. Now, if you are considered as an eligible person, then you can apply for the APA. There is a form number. No need to remember the form number, although I have given it. Why I have given it? Once you will qualify now, then you would be requiring these form numbers, so you can actually pick up the book and you can actually see that what is the form number. Guys, these notes are, I believe that you must have downloaded the notes. These notes are available on the mobile application. So please, you will be finding the description, this link in the description. You can go and download that. So person treated eligible may apply for APA after payment of the fees. So what is the fees, guys? If the value of the international transaction is up to 100 crores, the fees is 10 lakh, quite a good fee. So up to 100 crores, 10 lakh. More than 100 crores, but up till 200 crores, 15 lakh. More than 200 crores, it would be how much? 20 lakh rupees. So quite a good fee. Obviously, you are entering into such a high value of transactions. So this is the fees, 10 lakh, 15 lakh, 20 lakh. Okay, I have a question from you. Please tell me that whether this 100 crore is the value. Let's say, for example, you have taken the APA for maximum how much you can take for how many years? 5. Let's say, for example, you have taken the APA for 4 years. 4 years you have taken the APA. Please tell me, for each year, the value of transaction should be 100 crores. How you will see the value? No. Let's say if you have taken the APA for 4 years, then we will see that in this 4 years, how much would be the value of the transactions in the entire period which is covered by the APA. Got it? So it's not one transaction. It is not 1 year transaction. It is for the entire period of APA. Let's say you have taken the APA for 5 years. So it is for the entire 5 years value of transactions. If the entire, this is covered by the APA period, right? Covered by the APA period. So if the entire year, period transactions are up to 100 crores, 10 lakh. If the entire period transactions is more than 100 but up to 200, 15 lakh, and so on. If it is more than 200, 20 lakh. I believe this point is clear, guys. Okay. Now, very, very important. what is the time limit to apply for APA? When you should apply for APA? Now it's very important. Now you have to understand this. See, for example, there might be two scenarios. Let me discuss one by one. For example, this is the person in Limited, India, right? So let's say in Limited, for example, they are based in Chennai. So in Limited would like to enter into a very new transaction. So they would like to enter into a very new transaction somewhere in previous year, 25, 26. Let's say they have not yet entered. They are entering into a very new transaction. They have not yet undertaken. It's a very fresh transaction. So if you want to enter into a new transactions, but before that, you would like to determine the ALP of that, then when you can apply, guys, anytime before you enter into the new transaction, anytime before you can apply. So let's say you are planning to enter into a new transaction, which you have never entered in the past. Are you all okay with this? Which you have never entered in the past. So in other terms, what I can say, it's a very new transaction. So let's say, for example, you are proposing to enter into a transaction from 1st of November 25. So guys, before 1st November 25, you can apply for the APA. Understood? So it's written over here. Let's say in case of transaction which is yet to be taken, you are actually planning to take this transaction. So before undertaking the transaction, please apply for the APA. So before this transaction, please apply for the APA. Got it? Let's say now the second scenario. The second scenario is that you are in Limited. Let's say you are in Limited and you have an associate enterprise with the name US Incorporation, obviously based in US. The name says, I've taken this name so that you can understand it. Okay. So let's say Int Limited has already, they have an associate enterprise in US and they already do such type of transactions. It's an ongoing transaction. Can I say that it's an ongoing transaction? Understood now? No issues. It's an ongoing transaction. So you have already entered in the past. Let's say, for example, in the last 2-3 years also you have entered it and still you would be entering it. So it's an ongoing transaction. So when you can apply for the APA? So let's say it is an ongoing transaction. Some of the transactions already, I'm not talking about right now rollback provisions, guys. I'm not talking about the rollback provisions still. I'll be talking about rollback later. But as of now, I'm just doing for the normal thing for future years. So let's say if you want to take the transaction, guys, it's an ongoing. Now, from where you want to start? So let's say if you want to start it from the previous year, you will understand it better in the language of previous year in this case. Let's say from previous year 25-26, you want that my transaction, my international transaction should be determined by APA, right? My ALP should be determined by APA for this year, for previous year 25-26. Although you have already undertaken these transactions in last 3, 4, 5, 6, 7 years, but now you want APA. No, from whichever year you want APA, please apply before. Please apply before that. So what is this? This is 1st April 2025. So please apply before that if you want to take APA benefit from previous year 25-26, or I can say from assessment year 26-27. So previous year 25-26 is equal to assessment year 26-27. So I can say for any assessment year 26-27, if you want to take APA, so of that previous year, what is the first day? The first day is 1st April 2025. Before that, you have to apply, right? So if I'll apply in between, so from next year you will get the APA. Understood? So if it is an ongoing transaction, apply before the previous year starts. Correct? But if it's a new transaction, you can apply anytime before taking that transaction. Easy. In case of continuing transaction, before 1st April of previous year, relevant to the first assessment year for which application is made. So whatever the first assessment year from which you would like to take the APA, so take that relevant previous year. What is the relevant previous year? 1st April. Before 1st April of that previous year, please apply for the APA. Sir, can I withdraw once I have applied for the APA? I have paid the fees. Obviously, without fees, they will not do anything. So you have paid the fees also. 10 lakh, 15 lakh, 20 lakh, as the case may be. Sir, after applying APA, I found that no, I have done something wrong. So can I can I withdraw for the APA? Can I withdraw from the APA? See, once the APA is signed, then you can't withdraw. It will become binding. See, what happens is, see, what do you think, guys? Practically, what do you think? That today, if you apply for the APA, will you get the ALP tomorrow? Will you get the method tomorrow? No, it will take, it's a long process, guys. It's a long process. In fact, if you see the data from the income tax side, that how much APAs are entered, so you will find approximately in a year, they sign approximately 200 to 300 APAs only, right? 200 to 300, because it's a time consuming thing, right? So let's say, for example, you apply over here on this date. So it does not matter. It is not like that tomorrow you will get, after 1 week you will get the ALP. No, it takes time. It takes a lot of time, 6 months, 7 months, 8 months. It takes it, right? Sometimes a year. So it takes so much of time. So let's say you applied on this date and it got signed on this date. Now I want to withdraw. So guys, you can withdraw once you applied, you would like to withdraw. So please withdraw before it is signed. So before, signed means before APA is entered into. Once APA is entered into, you can't withdraw. Then it will become binding. So before it is signed, you can withdraw your application. Sir, what about the fees, sir? Will I get the refund? No, sorry, you will not get the fees refund. Right? So you will not get the fees refund. So you can withdraw it. Before finalization of APA. Understood? Before finalization of the APA. So you can write before signing of the APA. Before signing of the APA. When the same thing. Either finalization or signing off. Doesn't matter. But obviously the fees will not be refunded. Sorry, the fees, because they have worked on it. Why they will refund the fees to you? Right? The fees will not be refunded. Got it? But yes, practically, guys, I am telling you, let's say, for example, while determining your ALP, the department finds that, no, we should reject this. If the department finds that we should reject that, then they will refund your fees also. Right? Practically it is. Not written there. Right? So if it is not, department is rejecting it, then they will refund the fees. But if you are withdrawing it, your fees will not be refunded. Okay. Very, very important fifth point. Before I proceed on fifth point, before I jump on fifth point, I would like you to understand it conceptually. See, what happens is, understand it, guys. Conceptually understand it. Very, very genuine point, very logical point. See, what happens is, this is Int Limited, India, right? There is a taxpayer in India. The company entered into APA. So this is APA team, this is CBDT. And who controls, guys? Who controls this APA thing? Who is the boss over here? The Director General, the Chief Commissioner, right? The Chief Commissioner. And the designation, we also call it as Director General of Income Tax. He controls actually this. He is the boss over here. So under him, there is APA team. Now what will happen? Int Limited has entered into an APA, let's say for 5 years. So let's say for 5 years, you have entered into an APA. Let's say, for example, previous year, 25-26, previous year, 26-27, 27-28, 28-29, and 29-30. Correct, na? Okay. So this is how you entered into an APA for 5 years. Now, what you have to do is, let's say, for example, you have given certain information that these type of transactions we enter into. Guys, you have to, every year, you have to give a report, a compliance report. Every year, you have to furnish a report that, sir, I have entered into an APA for these years, 5 years, and sir, in this year, a separate compliance report for this year, a separate compliance report for this year, a separate compliance report for all these 4 or 5 years. that, sir, in this year also, I have entered into a very similar transaction. Whatever I have said to you, the same transaction. The facts has not changed. Everything is same. So you should actually, so while, because we understand that the APA, ALP should be valid if it is the same type of transaction. But if you change your transaction, then that ALP is not valid, na? Logical. So you have to give a declaration, a compliance report that, sir, this year also, obviously this year also, sir, my transactions are those transactions only which we have discussed together, right? So you have to give this compliance report. And guys, this compliance report, who will audit? The transfer pricing officer will audit this also, because the transfer pricing officer is an expert. So these people have said to TPO that it is your job to audit the compliance report. So what he will do, TPO will do, he will actually study what are their transaction which has happened during the year, what is that they are written in the compliance report, and what was they are written in the APA. So he will match everything. Yes, everything is correct, and TPO will actually furnish his audit report to the Director General. Correct. So he will furnish to the report to the Director General, the boss, Ind Limited, whatever they have said correct. Whatever they are doing it, it's correct for this year. So every year compliance report would be submitted by the person, and every year audit will be done by the TPO. Correct. See, annual compliance report. Every year, understood it now? No need to learn. I believe you got this. Every year. Why every year? Got it? Every year, assessee shall file an annual compliance report. They have to file an annual compliance report within 30 days of due date of ROI. So whatever is the due date of ROI, so this. So within 30 days of the due date of ROI. So let's say the due date of, obviously there is international transaction. So the due date would be what? 31st July, 31st of October, or 30th November? Obviously 30th November. So 30th of November, let's say 27 is the due date for this year. So what is written over here? 30 days of due date of ROI. So from this due date of ROI, you will get 30 more days. 30 more days you will get, and you have to give this compliance report. And who will audit this? The transfer pricing officer. See, I'll read this later. Audited by TPO. So this compliance report will be audited by the TPO. The TPO shall conduct a compliance audit. He will do a compliance audit. Yes, whatever you are saying is correct. As per the APA, it is correct. For each year covered under the APA. Correct, for each year. And submit the report to whom? Please don't learn it. To whom he will submit the report? So to the department, to CBDT, to the Chief Commissioner, Director General. And he will submit the report within 6 months. He needs some time now to do the compliance audit. So within 6 months from the end of the month in which the report is received. So once the report is received, come to the last day of the month. From that, we will give you 6 months. And please submit your report to the department, to your bosses. Understood? Now, please tell me, let's say, for example, let's say for this year, you might have already applied for the APA on 1/4/2020. Before 1/4/2025, you would have applied for the APA. But let's say it will take time. It will take time to get the APA signed, because it takes time, right? They will be looking at so many things. It takes time. So let's say what happened is, although your APA is valid for this year, but you got the APA very late, and those due date plus 30 days has expired. Now tell me how you will actually do the compliance, how you will file the compliance report, because you have to file the compliance report within 30 days from the due date of ROI. So let's say, for example, this APA came late. Then what they will say? They will say 90 days of entering into APA, whichever is later. So if this due date has expired plus 30 days has expired, so don't worry, we will give you 90 days from the APA when APA was entered. 90 days of entering into an APA, whichever is later. So still you have 90 days. Got it? Why 90 days is written? So generally, actually, this would be mostly practically it is applicable for the first year, because first year there might be chances that the APA came late. But from the second year onwards, now it will be this. Are you understanding it? Okay. Now, let us come to the second part of APA, which is rollback provision. So, rollback provisions. Tell me, what is rollback provision, sir? We can go for last years also. How many last? Sir, 1, 2, 3, 4, or entire 4? Sir, entire 4. Okay. One of the condition, if any of the condition is not satisfied for any 1 year, any 1 or 2 years, then for that we will not get rollback, but otherwise we should go for rollback for all 4 years. So rollback provisions, if opted, must be applied to all 4 years. It should be applied to all 4 years preceding the first previous year covered by the APA. Understood? Preceding the first year. See, this was the first year. Let me erase this, otherwise you will get confused. Okay. So this is the first year for which APA was taken. Correct. So let's say you have taken the APA for 5 years. One. Can you take the APA for 3, 4, 5 years? For future year, we have this facility that we can go for maximum 5. We can go for 3, 4 also, right? So let's say this is the first year for which APA is applicable for 5 consecutive years. So can you go for rollback? Yes. So you can go for rollback preceding to that the last 4 years. So what would be the last 4 years? The last 4 years would be 21, 23, 24. Can I write this way? These are the last 4 years. Got it? So previous year 25, 26. The last year would be previous year 24, 25. So you have, if you want rollback provision, it should be for all last 4 years. But yes, if the condition is not satisfied with any of this year, then you will not get the rollback for that year. But otherwise, you have to apply for the last 4 years. So rollback provisions, if opted, must be applied for all 4 years. Preceding all 4. I've highlighted this also. Preceding the first previous year covered under the APA and not applied at all. Either you go for all 4 years or will not go at all. Now, application fees for rollback. Sir, we have already paid application. That is the application fees you have paid 10 lakh, 15 lakh or 20 lakh as the case maybe for these years. We need fees for these years also. Income tax officers are working on your case. So they need fees for this also. So for this, they will need a fees of 5 lakh rupees. Correct? So for this, they need a fees of 5 lakh rupees. Now, what are the conditions to be fulfilled? Very, very important. Guys, what are the conditions to be fulfilled for these 4 years if you want to go for rollback? The first condition is that whatever the ALP, whatever the transactions which you are taking, whatever the transaction you are taking here, it should be the similar transaction here. It should not be different. Obviously, it's one APA, na? So whatever the transaction you are taking here, it should be same over here. First condition. It says international transaction is same as the transaction which APA applies. So international transaction should be same. So specified domestic transaction also should be same. On specified domestic transaction, APA is not applicable. Understanding it? Good. Understood? Okay. Now, this is the first condition. Conditions are very important, guys. Please mark them important. And especially few conditions are very, very important, guys. There is a questions which comes in examination on this. And probably in that lecture now where I'll be discussing just question and answer. So I'll be taking this question also. Very, very important. Especially the second condition and fourth condition. See, all are important. But especially this second and fourth is one of the things which they can easily ask. And they ask it also. Okay, what was the first condition? That the transaction should be same. Second, most important condition, that the ROI of all these 4 years should be submitted up to the due date of ROI. So how examiner will ask you? They will give you for any year the ROI submitted late. Guys, if the ROI is submitted late, now you can't go for rollback for that year. Only for that year you can't go for the rollback. So the ROI must be submitted up to the due date of ROI. Due date of ROI should be submitted. If it is submitted late, sorry, we will not allow you. So you have to submit the ROI up to 30th of November. Obviously, there are international transactions. So this ROI, 30th November 2022. This ROI, 30th November 2023, 30th November 2024, 30th November 2025. If any of the ROI is submitted late for that year, let's say, for example, this year ROI is submitted late. So you can't go rollback for this year, but for these 3 years, you can go. For these 3 years, you can go. Got it? Okay. Again, examiner will actually try to trap you here. Let's say he will say, sir, ROI is submitted on time. Let's say for this year, the ROI is submitted on time before 30th November, let's say 2025. But we have revised it later. We have revised the ROI later after 30th November. Doesn't matter. Doesn't matter because if original return is submitted on time, then revised return replaces the original return, right? So if you have submitted the revised return of the original one, so we are okay with it. So revised return is also okay. But please remember that, let's say, because belated return can also be revised. So let's say if you have not filed your ROI by 30th November, you have filed your ROI belated and you have also revised it. Can this revised return can be accepted? No, this will not be accepted because it is actually of belated return. Logically understood it now. So if it is a original return which is filed on time, you are revising that return, that's okay because revised return gets into the shoes of, you remember the ROI chapter, right? So revised return replaces the original return. So we are okay with this revised return, but we are not okay with the belated one. I believe you got it. Right now. So ROI for the relevant rollback year has been filed before the due date of as per the due date as per section 139.1. What is 139.1? The main section of filing of returns of income. Okay. Then, guys, the TP report should be also submitted within the prescribed time, right? The TP report I will discuss in 92E. We'll submit the TP report also. So which you take it from the chartered accountant, right? With the chartered accountant practicing CA issues to the assessee. So the TP report also should be filed on time, right? If the TP report is not filed, you will not get the rollback for that particular year. Sir, we will not get the rollback at all? No. Only for that year you will not get the rollback. So third point is that TP report in respect of the international transaction had been furnished in under section 92E. 92E will be doing a TP report by a chartered accountant. So that should also be furnished. Now what is the just learn what are the conditions? First condition, if you want to go for rollback, it should be similar transactions. Got it? Second condition, if you want to go for rollback, the return must be filed on time. If the revised return has been furnished of the original return, then it's okay, but not of belated. Third condition, the TP report should also be submitted for those years within the prescribed time. Fourth condition, let's say for this year, you have filed an ROI. For these rollback years, you have filed an ROI. Let's say your income you have stated here, let's say 10 crore. Here you have stated 15 crore. Here you have stated 18 crore. Here you have stated, let's say 20 crore. Right? This is your ROI. This is your returned income. Returned income understood? The assessee has said that my income is this of this year. Let's say after applying APA, very, very important. After applying APA, it cannot be reduced. Obviously, see, whatever you were saying, that is the minimum. It cannot be reduced by applying APA. Let's say you applied the APA, and let's say this year income is increasing. Let's say it is 11 crore by APA. So you are okay with it. So income tax department is okay with it. They will say, we will not reduce it beyond 10. So let's say, for example, this year, 15 crore, you have filed 15 crore. But APA, after applying the rollback thing, let's say it is getting reduced to 13 crore. So whether we will take 13 crore? No. Minimum 15 crore so we will take. Right? Minimum 15 crore so we will take. So you cannot reduce your return income. You cannot reduce your return. So I can say like this, you can not reduce your return income, or I can also say like this, that you cannot increase your losses, right? Your losses will not be increased, or I can say your income will not be reduced. I believe understood it. So my income should not be reduced by applying APA. No. But let's say, for example, there is a loss, 20 crore. Can you increase your losses? No. You can't increase your losses. If you say by applying APA, your losses become 22 crore. No, you can't increase your losses also. Easy. Yes, assessment, if assessing officer has done some assessment, that can be reduced. But whatever you have said, assessee, that we cannot reduce below that, right? So I have given an example also for this. Let's say case number 1. First, let me read it out. After applying rollback provisions, the income should not be reduced. The income should not be reduced. Or in other words, I can say that, let's say in respect of losses will not be increased below the returned income. Got it? So it could be either ROI or APA, whichever is higher we will take, not lower, right? Now, guys, even no need to remember it. Guys, no need to remember. Just apply your logic, na? You are such a smart guy. You're such a smart person. You know, our mind can absorb anything, but just don't mug it up. Please, please, please understand the things conceptually. You will retain it forever. Not only for examination, you will retain it forever. Now, let's understand with the, even you can actually, teach your friends also if you understand it conceptually, right? And guys, I'm telling you, once you teach your friend now, whether your friend will understand it or not, but you will understand it more better. So try whatever you learn now, try to share it with your friends also, so that what will happen, your concepts will be strong. Okay, let's understand with the following example. Particular case one, let's say income as per ROI is 40 crore, right? As per ROI, your income was 40 crore. This is your, the assessee was saying. Income as per assessment officer is 46 crore. 46 crore was assessing officer has determined the income, right? As per rollback, it is 42 crores. Sir, it is less than the assessing officer. See, assessing officer, it is less than that. It's okay. But it cannot go beyond, it cannot go below 40. So it is not going below 40. So 42 crore is a good amount. So whether 42 will apply, 46 will apply. APA is here. So AO provisions will not apply. APA will apply 42 crore. Correct? Tell me the second one. Your return income is 40. Assessing officer, what he has done, that is not that important. Rollback is 36. See, by applying rollback, can you go to 36? No. Whatever is your return income, 40. You can't go beyond. See, higher authorities has determined 36. But you can't deny, because you were only saying that you are having an income 40. You can't go below 40. Understood? Look at the last one. 10 crore losses you have shown. Okay. Let's say there is no assessment has been taken place by the assessing officer. And can you increase your losses by rollback provision? Your losses are increased. Can you do that? No, we can't do that. Maximum it would be 10 crore loss. So 10 crore is the final loss. Agree? Okay. Now few more points. Guys, few more points. One of the point is important. This point comes, they give you a question and they will give you a point on this. Okay. Guys, let's say for any year, ITAT, Income Tax Appellate Tribunal, or any authority, let's say for any particular year, if ITAT has already decided a case of any previous year, of any earlier year, ITAT has already decided the case. Can you apply APA over here? Can you apply rollback provisions over here? The answer is no, because your case has already been decided by the tribunal or higher authority. Understood? So if any case is finalized by, because ITAT is what? ITAT is a final fact-finding authority. Understand? ITAT is final fact-finding authority. So if they have already decided the case, then you can't go for the rollback for that. One exception, one point. Let's say your case went to ITAT, but ITAT has not decided it, but they referred back. Remember na, ITAT, remember the chapter of assessment procedure? Even if you don't remember, this is a very easy point. ITAT, what ITAT can do, ITAT can refer the case to the AO for fresh assessment. That please do fresh assessment, because ITAT finds that AO has not done his work properly. So let's say, for example, for any year, ITAT has not decided the case, but what they have done, they have just referred it back to the AO, do the fresh assessment. Guys, for that rollback can be taken? Yes, for that rollback can be taken. Now understood? So if ITAT has already decided the case, then rollback cannot be taken for that year. But if ITAT has not decided but referred the case to AO for fresh assessment, then you can apply rollback for that year. Got it? Very important point. Rollback provision will not apply. When it will not apply? When ITAT or higher authorities have decided the case. For such year, if ITAT has already disposed of the appeal at any time before signing of APA and ALP is decided. if ALP is decided by the ITAT, because they are the final fact-finding authorities, and before signing the APA, if they have done it, then you can't go for rollback provisions for that year. But however, if ITAT has not disposed the case, but what they have done, they have only set aside for fresh assessment. They have only set aside for fresh assessment, and they have referred to the AO. AO do the fresh assessment. So that is not amount to decided. So for that, rollback can be applied. Correct? For that, rollback can be applied. Second point, when rollback is not applicable. See, let's say, for example, A Limited would like to take the rollback. See, first of all, they applied for APA for future years, right? And they would like to take for the rollback of last 4 years. So guys, A Limited should be in existence in last 4 years, nah? So if A Limited does not have any existence in the last 4 years, how can they apply for the rollback? So they can go only for the future APA, but they cannot apply for the rollback. So it's very, very important that your existence should be there. Now what will happen? Let's say in the case of amalgamation, let's say A Limited, B Limited, they both amalgamated and become C Limited. So C Limited can only go for future years. Can C Limited can go for rollback? The answer is no. Why? Because C Limited was not in existence in that year. Got it? So it is written over here. Rollback can be availed by the person who entered into the international transaction. You must have entered into the international transaction. You were not there. Your existence was not there. So let's say A Limited, B Limited get amalgamated and become AB Limited. Can AB Limited can apply for rollback? No, they were not there in the past. But let's say A Limited, B Limited, and A Limited get merged into B Limited. Can B Limited can go for the rollback? Yes, because B Limited was there. B Limited might have entered into an international transaction. Got it? Similarly, the case of demerger. Let's say in demerger, what happens? Old company gets demerged and they form a resulting company also. Can the resulting company can go for the rollback? No, it was not there. But the demerged company can go because they were there. So let's say Raymond's Limited demerged into Raymond's Limited and Raymond's Consumer Care. So Raymond's Consumer Care is the resulting company. Can Raymond Consumer Care can go for the rollback? No, they can't go because they were not there in the past. But Raymond's Limited can go. Understood, I believe, easy. And rollback can be applied as long as the original return was filed. This I have discussed. The revised return. Revised return is okay if you have revised which return? The original one, which was filed on time. But if you have revised the belated return, then this revise will not help. Correct? Sir, can we withdraw the application? Yes, you can withdraw it. Okay. Let's say a person is saying, let's say A Limited is saying, let's say A Limited is telling us, sir, actually, I have applied for APA for future years. Okay. Sir, I have applied for rollback also. Okay. Can they withdraw for rollback? Yes, you can withdraw for rollback. No issues. You can withdraw for rollback future years. So it will be there. If A Limited says, no, sir, actually what I want to do is, I don't want for the future year. I want for the rollback. No, that is not possible. Obviously. See, rollback is the extra benefit which is given. You are saying, sir, give me that extra only. I don't want main. I don't want main. See, future is main. So if you want to cancel that extra, that is okay. But if you want to cancel the main one, that is not okay, obviously. So it is saying, if it is optional to withdraw rollback application, it is optional to withdraw you can withdraw the rollback application while maintaining the APA for the future years. You can maintain it for future year. You are keeping the main thing, but you are withdrawing the optional thing. That's okay. But vice versa is not okay, but not vice versa. Got it? So you can't say that, no, sir, please delete the main thing. I want only rollback. Not possible at all. Got it? Now, guys, the last point in APA, which is very, very important, last point, 92CD. So we have done section 92CC. Please tell me what we have done in 92CC. Sir, APA provisions. Can APA can be entered for specified domestic transaction? No, it can only be for international transaction. Can we go for 6-7 years for future? No. Maximum how many? 5. Maximum 5. We can go for less also. Can we go back also? Yes. How many? Maximum 4 or all 4? All 4, sir. It might be case that one or two of the condition is not satisfied in any any of the last year, then for that year we will not get the rollback, but we have to apply for 4 years, right? For remaining years we'll get it. Okay. Now 92CC we have done, that is for APA, and we have done the rollback provisions also. Very, very important, 92CD. Guys, understand, again I'm telling you logically, 92CD. Once, before I jump into the section, please tell me. Let's say this is a person, assessee, this is your client. Int Limited is your client. And for previous year, 25, 26, previous year, 26, 27, previous year, 27, 28, previous year, 28, 29, let's say previous year, 30, 31, right? Okay. This person has taken APA. And let's say this is the first year. This is the first year. Okay. So when he would have applied before 1st April 2025, he would have applied it. It will take time. It will take time. So let's say it took time, and you got APA very late. You got APA very late. In fact, after the due date of ROI. After the due date of ROI. Let's say, for example, this due date of this was 30th of November 26, and you got the APA late. You got the APA after the due date. See, if you got the APA before the due date, then there is no issue. You will file your return as per APA, right? But if your APA was signed after the due date, or let's say, for example, you have taken the rollback provisions, obviously the due date has already been expired. You must have filed your return earlier by the previous ALP or something, right? Now, so what will happen? Please tell me. Int Limited is your client. They came to you. They said, sir, now we got this APA. This is the 5 years, or might be the rollback thing. Sir, actually what happened is, this year return now we have already filed. This year return we have already filed, sir, before the APA was signed. Sir, what we should do? What we should do? Simple. File a modified return. File a modified return. So what Int Limited should do? Int Limited is what? Assessee. What assessee should do? They should file a modified return. See, for future years, still the due date is yet to come. So for that, there is no issue. We will file the return as per the APA. We will file the return as per the APA. But what will be that year where the due date has already expired and we have already filed the previous return? Because now it is of no use. Why? Because the APA came and you have to follow the ALP as per the APA. Or let's say it's a rollback year. No issues. File the modified return. So what assessees has to do? They have to file the modified return of those years where the return has already been filed before the APA. Simple. So what will assessee do? What will assessing officer do? I'll discuss, but let us understand one by one. What will assessee do? Easy. So what will assessee do? So such a smart assessee, what he will do? He will file a modified return, modified ROI by the assessee. If prior to APA, see, everything you will now read now, you will find that as if we know it already. If prior to APA, any ROI has already been filed for any previous year. If prior to APA, any ROI has already been filed. Let's say in our case, this year, ROI has already been filed. Any previous to which APA relates. APA was related to this year. Then such person, who is such person? Our assessee. Then such person shall furnish modified return. He should furnish a modified return in line with APA. As per APA, he has to file the return as per APA. Now, how much time limit we will give it to him? Very, very important. Within 3 months from the end of the month in which APA was entered into, we will give you 3 months. So whenever the APA was signed, come to the last day of the month. And from there, we will give you 3 months. From the date when the APA is signed, or from the end of the month when APA is signed, from there we will give you 3 months. Understood? Easy. So within 3 months from the end of the month in which APA was entered into. Okay. Now for this year, he will file a modified return. Now, what will IND Limited think? What would IND Limited see? Indians are so smart. What they will think? Okay, since I am filing a modified return, let us change some other things also, which are not international transaction, which is not related to this AP. Let us change some other things also, since I am filing modified return. Is it possible? Not at all. Only modified return is only for APA. So whatever is changed due to APA, only that change you can incorporate. You cannot incorporate XYZ changes. No, not all other changes. So it says only changes related to APA are allowed, not other changes. Easy, right? Very, very important. Easy. Now, what will our beloved assessing officer will do? See, what will our assessing officer will do? Now the APA came. Might be possible that our assessing officer might have already completed the assessment of any of those years. So might be possible. So, or any of the rollback year, he has already completed the assessment. So let's say, for example, our assessing officer has already completed some of the assessments. See, the assessments which are pending, or yet to be done. For that there is no issue, because what will assessing officer will do? He will, while assessing it, he will take APA into consideration. For that is no issue. The issue is only with those returns, those years where assessment has already been done. So what will our assessing officer will do? He will also recompute everything. So he will also recompute it. Will he be doing the entire reassessment or just the effect of APA? Just the effect of APA. Correct. And for that, we will give him 12 months extra. So obviously, whenever this APA happens, we will give you 12 months extra. So now, assessment or reassessment by the assessing officer. So what our assessing officer will do? If he has already completed before filing modified return, if before filing a modified return, he has already completed the assessment as per the previous return. Correct now? So if he has already completed the assessment as per the previous return, then what he will do? AO shall pass an order modifying the total income of such assessment year. So he will modify the income of that year as per the modified return. And time limit will be, we will give him 1 year more. Time limit will be within 1 year from the end of the financial year in which the modified return was furnished. So once the modified return is furnished, come to the end of the year. From the end of the month or end of the year? End of the year. Come to the end of the financial year, and from there we will give you 12 more months. 1 year we will give it to you. Correct? And if it is pending, then there is no issue. If it is pending, so you have to, whenever this return will be filed, you have to do it as per the return. Correct? As per the modified return. Let's say, for example, if the assessment has not yet completed, you have not yet signed it, and the assessee has given the modified return, so please do the assessment as per the modified return. But anyways, 1 year extra will be given to you whenever this APA is entered. So here also 1 year extra will be given to you. So if pending on the date of filing the modified return, so AO shall complete the assessment and consider the modified. So obviously he will consider the modified return, and additional 12 months shall be provided to AO for assessment, and we will give them additional 12 months to do the assessment. Guys, please tell me, this is APA, very, very important topic. How much time we have taken? Approximately 1 hour, 13-14 minutes. But yes, this provision was very, very important of APA. Let us come to the next topic. If you want to take a 5 minutes quick break, you can pause it and you can come back, right? Just take a 4 or 5 minutes break and then come back. See, now the next concept is primary and secondary adjustment. You should know what is the difference between a primary and a secondary adjustment. It's very, very easy. Very important topic, very easy. See, what happens is, let's say there is an assessee, for example, IND Limited India, and it has associated enterprises, same US, INC, US. Correct. Now, what they have done is, let's say, for example, IND Limited India, they have made a sale. Let's say it's an income transaction, correct? So in their P&L account, they have made a sale to US INC. How much? For example, of rupees 10 crores, right? And And now the assessing officer find or due to any reason, we are saying that the ALP is rupees 12 crore. Correct? So what we will do? We will say to End Limited that what you need to do is your income will be increased. Your income will be increased by rupees 2 crore because you are showing ALP at less value. So it is 12 crore. So you have to pay extra tax. So you have to pay extra tax. Your income will be increased. Correct? So this increase in income, have we made any accounting entry? No, no, no. Just as in taxation statement, his income is increased. So earlier they were showing it accordingly, according to 10 crore, but now it is according to 12 crore. So 2 crore would be the income which would be increased. So there is no such adjustment. There is no such adjustment in the books of accounts. But we are just saying to End Limited that you have to pay extra taxes on this 2 crore rupees. So this is called primary adjustment. So whether primary adjustment is a book adjustment, the answer is no. This is not a book adjustment. 2 crore you have to pay extra. Now, see, now Indian government will not stop here. Mr. Arun Jaitley was the one. He said that, okay, we have applied ALP, you have to pay taxes on rupees 2 crore extra. But Mr. Arun Jaitley said a very, very nice thing. What he said? He said, our country, see, you have paid taxes, that's okay. But this sale should have been 12 crore. So this person should have paid you, he should have paid in India, foreign currency, rupees 12 crore. So 2 crore more we should have received, and we have not received it. We want this money also. Please repatriate. Please repatriate this money. Please bring it back. Please bring it back, and not please, bring it back. You have to bring this back. End Limited, ask your associate enterprises that today Indian law is such a nice law that you can't do a transaction at any other value. It should be at ALP. And obviously this person has to pay 2 crore taxes on rupees 2 crore. This person has to pay taxes. But USINC, you have actually paid in India less amount. Our India is actually getting impacted by rupees 2 crore. Please send this 2 crore to India. You have to repatriate this money within 90 days. Please call this money within 90 days. And so what do you have to do? In your books, please make this person a debtor. End Limited, please make this person a debtor. So in your books also pass a accounting entry. Pass a general entry and make this person a debtor. What entry you should pass? You should pass, this is the accounting entry, you should pass End Limited. See, I am passing in the books of End Limited. What accounting entry I am passing? USINC debit to P&L account. Right? 2 crores, 2 crores. So we have to bring this money. And if this money they don't give within 90 days, 90 days I'll count from where? That is very important. I'll tell you. First of all, just understand the concept first. So you have to give this money within 90 days. And if you don't give within 9, first of all, make this entry. So this entry is called secondary adjustment. Sorry, this entry is called secondary adjustment. Understood what is primary adjustment and secondary adjustment? What is primary adjustment? See, primary adjustment is not a book adjustment. It is just that while determining your ALP, your income is increased, so you have to pay taxes accordingly. So this is primary adjustment. But secondary adjustment, we will not stop here. So Mr. Arun Jaitley is the one who brought this concept that we want this 2 crore rupees also, that to in foreign currency. Please bring it within 90 days. Pass general entry in your books of accounts and bring it. And if it is not repatriated within 90 days, if it is not brought back to India within 90 days, then End Limited, please charge interest also. Please charge interest also on this amount. Make it as a deemed advance. Make it as if you have given a loan, as if you have given a loan, as if we have given an advance to US Incorporation, and please charge interest also. Sir, at what rate? I'll tell you at what rate. So please charge interest also. Interest rate is also defined that you have to charge interest also. And End Limited, we will also, whatever the interest you have to charge, and that interest will also will become your income. We will take that interest portion also. Understood? Such a beautiful law they have made. They have said that ALP provision will apply, but please, you have to bring this money back. You have to bring this money back. One important point, if this difference, if the money which needs to be repatriated, if it is up to 1 crore, then we will leave it. Up to rupees 1 crore, we will leave it. But if it is more than 1 crore, we will not leave it. So secondary adjustment, when you have to pass, if the amount which needs to be repatriated is more than 1 crore. If it is up till 1 crore, then leave it. No requirement of secondary adjustment. Got it? Second thing, please charge interest also if it is not repatriated within 90 days. And now interest should be calculated. The rate has been defined. We will see that whether this transaction is in Indian currency or it is in foreign currency, the rate would be depending on that. Correct? And if you don't bring within 90 days, we have to apply interest also, charge interest also from them, and we will tax that interest also in your books. So we will also be taxing you for that interest. Understood? So let us read it one by one. First of all, primary adjustment. What is primary adjustment? Do we make any book entry? The answer is no. We don't make any book entry over here. It is just as per your ALP, your income is increased. That is, you have to pay the taxes on that. It means correcting the transfer price, because the transfer price was how much you have shown. Actual price was 10 crore, but the ALP was 12 crore. So please make it 12 crore. No need to pass the book entry. Just your income would be increased, India Limited. So it means correcting the transfer price to arm's length price, which increases income or reduces the loss of the assessee. As of now, you can write, learn it by this. It increases the income, or you can also say reduces the loss. Now, I have given a note over here. What is a primary adjustment? It is not a book adjustment. It represents a tax adjustment. It is just a taxation adjustment, not a book adjustment, not a book entry made under the act, and is not a book or an accounting adjustment. It is not at all an accounting adjustment. What I'm talking about primary adjustment. The taxable income of the assessee actually changes due to this adjustment. Only the taxable income is changing. But second thing which Mr. Arun Jaitley brought out is a secondary adjustment. He said that it is you have to bring this money back also. So what you need to do is, it is an adjustment in the books of accounts of the assessee. It is an adjustment in the books of accounts of the assessee. You have to actually make that person a debtor, the assessee and its associate enterprises, so that the excess money shall be with the associate enterprises, the excess money which is lying with him. How much is the excess money? 2 crore rupees is the excess money. You have to bring it back, and we will make it as a deemed loan or a deemed advance. So how much is the excess money? If somebody will ask you how much is the excess money, sir, ALP was 12 crore. Your actual transaction price was 10 crore. So this difference is the excess money. And if this excess money is not more than 1 crore, leave it. No requirement of secondary adjustment. But if it is more than 1 crore, then you are required to pass this entry, right? But yes, before this law was introduced, so it is not a retrospective effect. The day when this law was introduced, from that only the effect will be given. So it is written over here. That is important, that the secondary adjustment is not required. The secondary adjustment is not required if the primary adjustment does not exceed rupees 1 crore. Very, very important, guys. Very important. You have to learn this. If the primary adjustment does not exceed, the excess money does not exceed rupees 1 crore, no requirement of the secondary adjustment. Also, this point is not that important because it is quite an old point now, or any adjustment made for assessment year 16-17 or before. So any adjustment which is made before 16-17. Why? Because before that the law was not there, right? So this is not important now. It was important at the time when it was introduced, but now it's not important. It's been some 9 or 10 years. Now this is not that important, right? But this is important, that it should be more than 1 crore, then only you will pass the secondary adjustment. So this is the excess money. So now what is the repatriation provision? That you have to bring this within 90 days. So repatriation provision says the excess money must be repatriated to India. India is losing within 90 days from the prescribed period. Otherwise, it is considered as a deemed loan, and interest shall also be charged. Interest, you should charge the interest also on that, and Indian authorities will make that interest also your income. So the interest shall also be accrued on such loan at the prescribed rate, and such accrued interest is also included in the assessee's total income. Got it? Such a beautiful law. Now let us understand, sir, what is the rate of interest? Very, very easy and important. That what is the rate of interest? It depends that this international transaction is denominated whether in Indian rupee or it is denominated in foreign currency. So if it is denominated in Indian currency, so rate of the interest on such deemed loan, I'm on page number 15.13. The rate of interest on such deemed loan or advance would be, so it depends that this international transaction is denominated in which currency, Indian currency or foreign currency. If it is denominated in Indian currency, then you have to apply SBI lending rate. Lending rate will be given to you. SBI lending rate plus 3.25%. So the rate of interest would be the SBI lending rate plus 3.25%. See, if the SBI lending rate is, it will be given to you in your examination. If it is a Indian currency, denominated in Indian currency, SBI rate, SBI lending rate plus 3.25%. So let's say, for example, SBI lending rate is 7%. So 7 plus 3.25% is what? 10.25% would be the rate of interest per annum. Got it? Sir, SBI, which date rate we have to take? We have to take the relevant, whatever is the relevant previous year, we have to take the 1st of April. 1st of April of previous year, what is the SBI lending rate plus 3.25%, right? So let's say, for example, your interest is getting due. The interest is getting due in previous year 25-26. Then we will say that 1st April 2025, what is the SBI lending rate plus 3.25%, correct? And if it is denominated in foreign currency, then you have to take not the SBI rate, you have to take the LIBOR rate, London Interbank Offer Rate. So LIBOR rate plus 3.25 or 3%. So here LIBOR rate plus 3%. So LIBOR rate, let's say LIBOR rate is 8. 8 plus 3 becomes 11% per annum. You have to charge this interest, right? LIBOR rate of which date, sir? It is also a 1st April of the previous year. No. It is not a 1st April of the previous year. This is it is 30th September of the previous year. Which previous year? I'll give you the example. Then we'll understand better. So it is 30th September of the previous year. So if it is denominated in foreign Indian currency, SBI rate plus 3.25%. Please learn 3.25%. And if it is foreign currency denomination, then it would be LIBOR rate plus 3%. Again repeating, if the rate of interest on such deemed loan would be, if it is an international transaction is denominated in Indian currency or foreign currency. If it is Indian, SBI lending rate as on 1st April of the previous year or plus 3.25%. If it is foreign currency, 6 months LIBOR rate as on 30th September of previous year, it will be given to you in your examinations plus 3%. So in LIBOR, add 3. In SBI, add 3.25. Got it? We will calculate the interest. If it is not, if it is repatriated within 90 days, we will not calculate interest. But if it is not been brought into India within 90 days, then we will start calculating your interest from very beginning. From very beginning, we'll be calculating the interest. Now, from which date we have to calculate the interest? Now it depends, guys. Now it depends that why you have made the primary adjustment or how you have made the primary adjustment. So please tell me, a person, when he make the primary adjustment, see, it depends upon certain situations. It depends on certain situations when we make a primary adjustment, when our income would be increased. See, it happens. Let's say, for example, there is Ind Limited. Okay, I'm taking the same example, Ind Limited. Let's say for the previous year, 25-26, they have shown in their P&L account, they have shown that we have made a sale of 10 crore. They have shown it. But when the assessing, their chartered accountant was actually determining the ALP, the chartered accountant itself, their chartered accountant itself, right, the auditor, he himself, the person who will issue the TP report, he said, no, sir, actually the ALP should have been 12 crore. The ALP should have been 12 crore. So whether the department is involved as of now? No. As of now, assessee is dealing with his chartered accountant. So the chartered accountant was saying, the person who was issuing TP report, that the ALP should be 12 crore. So you have done it at 10 crore, which is wrong. So in order to avoid all the penalties, the chartered accountant is saying, sir, please show it at 12 crore only. So what does the assessee will do? Assessee suo motu. Assessee suo motu. When he will file his return. So when he will file his return, he will make the primary adjustment. He will himself will make the primary. Possible na? So whether he will wait for the assessing officer or he can do it himself. So the assessee can do themselves that, yes, sir, suo motu, we are accepting that our actual transaction price is not correct. The ALP should have been 12 crore. So let's say in our return, we will show that. So when he is doing it, he will be filing the return. So generally when we file the return, due date of ROI. So due date of ROI, probably before that also we can file, but generally due date of ROI would be the filing date, right? So you have to bring this money. This money is more than 2 crore. Yes. So you have to bring this money within 90 days. Guys, please tell me. Don't learn. Try yourself. That from 90 days we'll calculate from where? From the due date of ROI. From the due date of ROI, we will calculate your 90 days. So from this due date of ROI, we will calculate your 90 days. And let's say, for example, your due date of ROI is 30th November 2026. Then from this date, we will calculate your 90 days. If you bring this within 90 days, then no interest. If you bring this within 90 days, then no interest. But if you do not bring within 90 days, then we will start your interest after 90 days or from here itself. Very, very important. So let's say, for example, you have to bring this money within 90 days. So when will 90 days get over, guys? This is 30th November. Within next 90 days, please bring this money. So November is gone. December has 31 days. January has 31 days. How much? 62. To make it 90, 28 is more. So this is December, this is January, this is February. So it means that you have to bring this money by 28th of February 2027. Correct now, within 90 days. Guys, if you able to bring this money from that associate enterprises within this period of 28 February 27, very good. You don't have to charge any interest, because who will charge interest? They have to charge the interest, which will become the taxable income also in India. So if this money you are able to bring by 20th of February or before that, we would be happy. You don't have to charge any interest. But if you bring it late, let's say, for example, you bring this money, let's say on 15th of March 27, this is now after 90 days, then you have to charge interest. Interest from where? From the due date of ROI. From the due date of ROI, this date also we will include. This date also, I'll explain you with the help of example. This date we will also include, and from this date we have to charge the interest rate. So it depends if it is denominated in Indian currency, SBI rate plus 3.25%. If it is in foreign currency, LIBOR rate plus 3%. Right? We'll do the example. First of all, understand the concept. See, cases where secondary adjustment is required. There are 5 cases. So just understand one by one with logic. Okay. So if the primary adjustment is made by suo motu by the assessee in his ROI, the assessee himself is making his ROI. Why? His chartered accountant told him that, boss, it is not 10 crore, it is 12 crore. Okay. So his chartered accountant told him. So what he did is, so repatriation time limit, you have to bring this money from 90 days from the prescribed date. See, it's written over here now, 90 days from the prescribed period. Now it depends that what is the circumstances and what would be the prescribed period. So here, if the circumstances is that the assessee has made primary adjustment, the primary adjustment is made suo motu, then from the due date of ROI, you have to bring this money. And if you don't bring this, if you bring this money within 90 days, no issues. But if you don't bring this money, from interest period will start from the due date of ROI. From the due, whether we'll start from 30th November or we'll start from 1st of December, from 30th November itself, that day will also be counted. So from the due date of ROI, you have to pay you have to actually calculate the interest, make the interest accrued, and we will make that interest as your income also. Right. Now, the second situation could be whether the primary adjustment is made by the assessee himself. Okay. Sometimes assessee has not made it. Who made it? Assessing officer. So when assessing officer will pass his order, so from that date, you have to count the 90 days. Correct now? So the primary adjustment can be made suo motu also. There are various cases, right? So typically there are 5 cases. So if it is been made suo motu, then you have to bring this money within 90 days from the due date of ROI. Or if, let's say, you have not done it assessee, but the assessing officer has done it, or let's say ITAT or any appellate authority has done it. So from the order of the assessing officer assessment order or from the appellate authority's order, you have to bring within 90 days from that day. Correct now. So they have said that if made by the assessing officer, the primary adjustment is made by whom? By the assessing officer. Assessing officer has passed his assessment order and he has made the second primary adjustment. Then from the date of order of the AO, from the date of order of the AO, please bring this money within 90 days. Or AO has not passed, but the appellate authority has actually passed an order. So from the order of the appellate authority. Easy. Guys, for examination, I'm telling you, please remember assessing officer orders, right? It is more important. It can also come, but it is same, right? Now, interest period will start from the same date. From the date of order of the assessing officer or appellate authority, we will start from that date. If it is brought within 90 days, no interest. But if it is brought after 90 days, then start calculating your interest. Okay. If the primary adjustment, now it depends that whether the primary adjustment has been made, might be through APA, right now. Your APA, you have determined your ALP through APA, and this ALP, when you have applied it, it was increasing your income, and income was increasing to such extent that it is more than 1 crore rupees. So bring that money also, right? So if the APA, if by APA it was you have made the primary adjustment, now APA entered up to the due date or APA entered after the due date. See, if the APA has already entered up to the due date, up to the due date means what? That when you were actually filing the return, already APA was entered. Or whether the APA is entered after filing your ROI, then what will happen? If you have entered the APA up to the due date of ROI, means the APA was entered already, and after that you have filed your return. So from the actual date of filing the ROI, because you were knowing it now, so already because there was an APA, you are already knowing that what is my ALP. So from the actual date of filing of ROI, you have to calculate those 90 days. So if it is brought within those 90 days, we are okay with it. Correct? But if it is not brought, then we will calculate the interest. Here is a little change. Here it says, because everywhere you will find in first case, second case, fourth case, fifth case, and third has two parts. Only in this first part, there is a little change. We will calculate your interest from the due date of ROI. So your 90 days, see, generally in all the cases, 90 days also will be counted from the same date. Interest period will also start from the same date. But in this case, if the APA is already entered before the due date of ROI, it means that at the time, so what do we mean? We mean that at the time of filing ROI, we already know what is my ALP. We already know what is my correct ALP, right? So from that date, you should actually ask your associate enterprises, please give us 2 crore rupees back, right? I'm assuming it is 12 crore. So bring us 2 crore rupees from this date, 90 days. But we will start your interest. So we are giving a little relaxation to you that we will start your interest not from the actual date of filing, but from the due date of filing. So here actually little benefit is given to the assessee that we will start your interest from the due date of ROI. Correct. But if APA is entered after the due date of ROI, means already you have filed your ROI and then thereafter the APA is entered. So because at the time of filing ROI, you were not knowing that what is ALP because there was no APA. So when APA will come, then only you will be able to understand that yes, this is the ALP and this is the amount I need to bring it back. Correct now? Logical. So here, if AP is entered after understanding it, after the due date of ROI, please guys don't mug it up. Please understand the concept that the due date of ROI has gone. It means that you must have filed, the assessee must have filed the ROI, and after that the APA is coming. So when the APA will come, the APA is signed, then only he can understand that this is the ALP. So from that date only he can actually tell his associate enterprises that please bring that excess 2 crore rupees back in India. So from the end of the month in which APA is entered, because now APA becomes important over here, right? Because APA came after filing your ROI. So when APA will come, then only you will be able to understand. So here It is APA. When APA was entered, from the end of the month, come to that end of the month, and from that 90 days, you have to bring this money back. And if you don't bring this money back, we will start your interest. From which date we will start the interest? Same date. From the end of the month in which APA is entered, from this date, everywhere it is same. 90 days will also be counted from that date. We will start the interest period also from that date. Correct? Okay. If primary adjustment is made, by way of safe harbor rules. So safe harbor rules we have not yet done. We'll be doing it in a separate class. So safe harbor rules, if you have actually made, what is safe harbor rules? That your income or your ALP is predetermined. It is predetermined in some of the situations, and for some of the industries, it is predetermined. It is kind of a presumptive that you can follow this. So if by following safe harbor rules, your primary adjustment has happened, and the primary adjustment is more than 1 crore. So made as per safe harbor rules. So from the due date of ROI, because you understand that at the time of ROI, you know that there are already safe harbor rules. So from the due date of ROI, we have to bring your 90 days. We'll calculate your 90 days. Please bring the money within 90 days. But if you will not bring, start calculating the interest, and interest will be calculated from the due date of ROI. Correct? If due to the resolution of mutual agreement procedures entered under DDAA. See, we understand that although there is a separate topic for it, there is a separate chapter for it, MAP, mutual agreement procedures. See, what happens is, whenever the Indian competent authorities, who are competent authorities, guys, actually, for every country, and especially India also, in India, there is a team of some highly designated joint commissioner, and these are the Indian competent authorities. Whenever the DTA is signed, these people have major role. So Indian competent authority versus, let's say, for example, any other competent authorities. So let's say US competent authorities, they both sit together. And they actually form an agreement. Which is known as MAP, mutually agreement procedures. So this is known as MAP, mutual agreement procedures. So if because of the mutual agreement procedure, the ALP was determined. Because of the mutual agreement procedure between both the countries, the ALP is determined. If the ALP is determined by mutual agreement procedures, then from the date of giving effect by the AO to the MAP. So whenever the AO has actually accepted this MAP, from the day when he has given the effect of this MAP, from that date, you have to actually will calculate your 90 days, and your interest will also be started from these days. Understood? Now, it is written, interest income is computed every year till such excess money is repatriated. So if you will not bring this money after, let's say, 1 year, 2 years, 3 years, every year we will calculate your interest, and which interest rate we will take for every year, whatever year it falls. Whatever year this interest belongs to, we will take the, let's say, for example, it is in Indian currency. So we will take the SBI lending rate of that particular year. So this is called relevant year, right? So relevant year is not that year where international transaction is happening. No, it is the year when you are supposed to bring this money from the day when this interest belongs to. So for, let's say, for example, you are bringing this money after 3 years. So for first year, the 1st April would be something else. For second year, 1st April would be something else. Third year, for 1st April would be something else. So we'll be doing a question also on this, so that you will better understand that which relevant year we are discussing of, right? Okay. Now, it is such a beautiful law they have made. They said that because of, Arun Jaitley said, okay, due to any reason, if you have done India Limited, if you have done a transaction with your associated enterprises, who's that? USINC, USA. You have done the international transaction with them. So please ask them to give you the money within 90 days, right? Ask them to give you the money. If due to any reason, the money could not be brought from US, Arun Jaitley says, no, we need foreign currency. You must be having some other associated enterprises, non-resident. You must be having some non-resident also, no? Who is your associated enterprises? They might say yes. Let's say there is any other associated enterprises. Where? Let's say in UK. In UK, in London, let's say they are sitting. So please ask any other associate enterprises. So either you can repatriate the money from the same associate enterprises, or you can also repatriate the money from any other non-resident, any other associate enterprises also. If you bring this money, if either they will give you or any other associated enterprises who is situated abroad, they will give you, we will be happy enough. It will be assumed that yes, the money has been repatriated. This was the law which was made by. So I can say two options were given. So this was option number one, from the same associated enterprises. This is option number two, from any other associated enterprises also. But later, industry came out with their concern. They said, when finance minister was Mrs. Nirmala Sitharaman, and still she is, she has made a little more amendment, because industry has actually given a representation. Ma'am, due to some reasons, now it is not possible to bring the money from outside. So Nirmala Sitharaman made one more amendment in this section. She said, okay, if you could not bring the money from outside, so whatever is your excess money, you have to pay additional tax on it. You have to pay, so smart. You have to pay additional tax on it. And please pay within same 90 days. And if you don't pay within 90 days, then start calculating the interest also on this excess money. And now the additional tax would be on the combined portion of excess money plus interest. I'm again repeating. Let's say the excess interest is 2 crore. So she said, if you are not able to follow these options, then I am giving you one more option. That whatever is your excess money, let's say 2 crore. On 2 crore, you have to pay additional tax. How much is the additional tax? 18% tax plus 12% surcharge. So 18 plus 12%. 12% on what? 12% on 18. So how much it will become? 18 plus 12%, it will become 20.16. Correct? 20.16. Can you calculate in your calculator? Plus 4% says, obviously, plus 4%. How much it will become? 20.9664. 20.9664. You have to pay additional tax on the excess money. So let's say your excess money is 2 CR. Right? Your excess money is 2 crore. So on this, you have to pay 2.9664. 18%. If 20.9664 is difficult to remember, please remember that is easy. 18 plus 12 plus 4. Right? 18% additional tax, 12% surcharge on it, plus 4%. 20.966. 4% you have to pay additional tax on that. And if you pay within 90 days, no issues. No secondary adjustment required. Don't make any secondary adjustment. Just pay this additional taxes. You are free. Right? However, if you could not pay the additional tax, please pay additional tax within 90 days. And if you don't pay within 90 days, we will start calculating the interest. On excess money. Let's say the interest randomly it comes to 5 lakh rupees. So now we will take 20.9664% on 2 crore or 2 crore plus 5 lakh. On 2 crore plus 5 lakh, we will take this. Understood? Such a beautiful law. See, assessee has the following 3 options to repatriate the excess money. Understood? Everything you are able to understand now? So first, option 1. Such excess money must be repatriated from the same associated enterprises within 90 days from the prescribed date. So such excess money must be repatriated from the same associated enterprises, US Inc. Please bring the money. With whom the assessee carried the international transaction. Option number 1. If it could not be possible, bring it from some other. Such excess money repatriation can be from any other non-resident associate. We need foreign currency. We don't need Indian currency. We need foreign currency. So from any other non-resident associate enterprises, not necessarily the same associate enterprises should replicate it. So it's not hard and fast that you should bring only from US Inc. You can bring from UK, you can bring from Australia, you can bring from Dubai. No issues, right? But bring in foreign currency. Now, Nirmala Sitharaman has given one more benefit to the industry. They said, okay, if somehow these options are not possible, okay, pay additional taxes, don't worry. No need to do the secondary adjustment. So the assessee has an option to pay additional tax at a rate of 18 plus 12% surcharge plus 4% cess, which will make it to 20.9664% on such excess money, right? Option to pay additional tax at 20.9664. If such additional tax is paid, then no requirement to do the secondary adjustment. Then the assessee is not required to make any secondary adjustment and no interest shall be computed from the date of payment of such tax. Once you pay the tax, now we will not calculate interest. But however, if you pay within 90 days, then just pay additional tax on excess money. And if you don't pay within 90 days, then excess money plus interest on that amount, we will charge the additional tax. Additional income tax paid to be paid on excess money in addition to interest. In addition to interest, you have to pay additional tax, right? Within 90 days. See, if you pay within 90 days, then just pay additional tax on excess money, not on interest. No need to compute interest. Not required to compute. See, if the money is repatriated within 90 days, no requirement to compute interest. If the additional tax is paid within 90 days, no requirement to compute the interest. But if the additional tax is paid after 90 days, so first of all, compute the interest. Compute the interest till the payment, till you make the payment, and we will take the additional tax on excess money plus interest. So compute interest from very beginning till the date of payment. From very beginning, from what? We start the interest from after 90 days are over, or from very beginning? From very beginning, right? And of this additional tax, you can't carry it forward. You will not get any credit on all. This is the extra type of, we can say it is an extra type of penalty we are levying. So don't take any deduction of this tax. So you can't claim it as a expense in your PGBP. You can't carry it forward, right? You will not get any credit of this, right? This is some extra burden we are actually levying on you. So no deduction is allowed under any provision of the income tax. You will say, okay, sir, can I claim this as my business expense? No way, right? Neither any credit will be available. You can't carry it forward, any credit, nothing. Just pay and leave it, right? Let us do a illustration on this. I would like to discuss an illustration on this. See, okay, this one visible. See, it's written over there. XYZ Limited is having an associated enterprises in UK, namely Beta PLC. Okay, this is XYZ Limited. They were having associated enterprises. Who was the associated enterprises? Beta PLC. So Beta PLC, it was in UK. Very good. So during the financial year 24-25, okay. So during this financial year, XYZ Limited exported goods at a price of 100 crores to Beta PLC. So we have exported goods at a price of what? 100 crores. Okay. The arm's length price of this transaction is 110 crores. So the arm's length price is the ALPS 110 crores. So please tell me what is the primary adjustment? So the primary adjustment will become how much? 10 crores. The excess money would be 10 crores, more than 1 crore. Secondary adjustment is also required. Transaction was designated to Indian rupees. Transaction was designated in Indian rupee. Foreign currency or Indian currency? Indian currency. Yani, it means SBI rate plus 3.25%. And XYZ Limited suo motu made the primary adjustment. You made the primary adjustment suo motu. So it means that this is the previous year 24-25. So it means the due date would have been what? The due date would have been, the due date of ROI would have been, because there is an international transaction, 30th November. 30th November of what? Everyone, please tell me 30th November of 2025, right? You should bring this money from this due date plus 90 days. So tell me, this 90 days will come on what? November. From this, calculate 90 days. So December has 31 days. We just calculate. I think 28th February was there, but still 31st December has 31 days. January has 31 days. 62 over 28 days of February. So it means this money should be brought into India by 28th of February 2026. Everybody is okay with this? This money should come to India by 28th of February 2026. If you bring this money within this period, if you bring this money within this period, then we would be happy. There is no interest required. Just pay additional tax. Just pay additional tax on what? Additional tax on 10 crores. So if you bring this money up till this date, then don't calculate interest. Just pay additional tax on 10 crores. And if you don't pay the money by this date, then we will start your interest. From which date we will start? From the due date of ROI. From very beginning, we will start your interest. Till the time you don't pay the taxes. So till the date of payment of taxes, we will calculate your interest. Okay. Let us see. Discuss the applicability of Section 92 CE and the implication in XYZ Limited pays additional tax on. If XYZ Limited is taking which option? They are taking the option of paying additional income tax. So they are taking the option to pay additional income tax. Very good. Case 1. They paid additional tax on 10th of January 26. Now please tell me. Case 1. They pay additional tax on 10th of January 2026. Please tell me whether they have paid the taxes within 90 days. Yes, sir. In case 1, they have paid the taxes within 90 days. So in that case, in case 1, what they have to do is they have to pay additional tax on what? Additional tax they have to pay. How much? 20.9664 na? 18% plus 12% plus 4%. Of what? Percent of what? 10 crores. So you can calculate. Correct. So it would be this. And if the money is repatriated on 14th March 2026, if the money is repatriated on 14th of March 2026, so please tell me whether the money came within 90 days or after 90 days. Sir, it is after 90 days. This was the 28th of February and you are bringing the money on 14th March. So we will calculate the interest also, and then we will add in the excess money, and then we will actually calculate your additional taxes. Okay. So what we will do over here, very good. So in this case, see, case 2. Guys, if you want to write now, please write. Please write. Do you want a full? Okay. If you want to take a screenshot right now, or you want to pause the video right here. So this is case 1. This is case 1. And 10 crores into 20.966%. It would be 2 crore 9 lakh 664. This is the amount, right? This is the amount which you have to pay additional tax in case number 1. And in case number 2, the money is, you are bringing this money on which date? On 14th of March. On 14th March 2026, you are bringing this money. Okay. So if 14th March, you are bringing this money, case 2. If you are, sorry, you are not bringing the money, but you are paying additional taxes. Okay. So 14th March 2020. Give me a moment. What was the due date for this? Correct, 30th September. Right. So you are bringing the money on 14th of March 2026. Okay. Please tell me, you are making the payment, not bringing the money. Why I'm saying bringing the money again and again? You are making the additional tax payment. Okay. So from interest period will be from the due date of ROI till what? Till the date of payment of additional tax. payment of additional tax. So from the due date of ROI till the date of payment of additional tax, please tell me what it will be. It will be from due date of ROI. So due date of ROI is what? 30th November 26. Is it 26 or 25? 25. What's happening to me? Tired? Okay. 30th November 2025 till what? 14th of March 2026. Okay. So 1 day of November, December 31 days, January 31 days, February 28 days, and 14 days of March. How many? 1 plus 31 plus 31 plus 28 plus 14. 105 days, guys. 105 days. So now, first of all, calculate the interest. So interest would be interest on excess money. How much? It is the excess money was 10 crore into rate into how many days? 105 days out of 365 into rate. Please tell me which rate? SBI rate. SBI rate plus SBI rate. Now understand, guys, which year SBI rate? SBI rate plus 3.25%. Now tell me, SBI rate we have to take of first. Now understand this. This is important. 1st of April. 1st of April of what? 1st of April of what? This transaction we have done in the previous year. This transaction we have done in previous year 24-25, right? Now, very, very important, guys. You have to concentrate on this. So 1st April of what? 1st April 2024. Is this 1st April we have to take? I'm confusing you, right? Is this 1st April we have to take? Or we have to take the interest belongs to? Is this interest belongs to which period? The interest belongs to 30th November 2025 onward. So what you have to take? That this is the relevant year. This is the relevant year, which the interest, because every year the interest will be calculated. So what you have to see that we are calculating interest for which year? So we are calculating interest for this period, right? From 30th November 2025 onward. So this 1st April would be 1st April 2025. So please tell me, you have to take the SBI rate. See, 3.25% though you will remember, but examiner will confuse you on this. What he will do? A good examiner like me, he will give you both the date rate of SBI. Which date rate? Which date you will pick? Guys, you have to pick the period to which you are calculating this interest, 1st April 2025. See, if you will look at it also, I have given you the same thing. I have given it to you. Assume 1 year marginal cost of lending. Assume 1 year marginal cost of lending of SBI as on 1st April 2024 is 7%. 1st April 2025 is 8%. Which one you will take? Sir, 8%. Got it? So here you will take 8%. So 8% plus 1st April 2025. This is 8% plus 3.25%. It makes 11.25%. Everybody's okay? Good. Are you enjoying the class? You should understand it. Rather than enjoying, everything should go very smoothly in your mind, right? You should understand the concept should be very, very strong so that the question can come from anywhere. You should able to able to solve it. You should know that what the examiner is asking and what is expected from you and how you are presenting it. That is very important. Okay. So this is 11.25%, right? So tell me how much it would be. 10 crores into 105 divided by 365. So this is 32 lakh 36,301. I can write. What is this, guys? This is interest. This is interest, right? Now, please tell me now additional tax would be, now additional tax. What is additional tax? 18% plus 12% surcharge plus 4% cess, which was 20.9664% of what? Of excess money plus interest. Understanding it, very, very important. Excess money plus interest. So how much is the excess money? So 10 crore. So 20.9664% of what? Of 10 crore plus 32 lakh 36,301 into 20.9664. Now I'm not doing it. Should I do? Okay, sir, please do it. Okay. 20.964%. Is it coming like 2 crore 16 lakh 44,935 or 6 936? This is the additional tax, right? So without interest, the additional tax was what? 2 crore 9 lakh something, and with interest, the additional tax should be 2 crore 16 lakh. I believe that you got it. This type of questions are important for examination purpose. Easy. Let me check it also whether I have done correct or not. Whether my calculation was correct. Let me check it from here only. Yes, 216,44,936 correct. And where is that one? Without, this is 209 2096644. Correct. Both correct. Got it? I believe that you have done this. Done now? Readable. Okay. Okay. Now, this was primary and secondary adjustment. So I believe that secondary adjustment things are clear to you. Okay. Now let us come to specified domestic transaction. It's a very easy topic, very small topic. Specified domestic transactions. See, what happens is, now the law again in 2012 they brought for specified domestic transactions also. Earlier, when transfer pricing was introduced in India, when TP was introduced in India, it was only for international transactions. But later we found that no, there is a requirement that we should bring TP to specified domestic transactions also. Not all transactions, only some specified transactions. These are the transactions. Right? These are the transactions. What happens is, actually, guys, we have some sections in income tax which give major relief to the assessee, like section 10AA, tax holiday. You know it now? 10AA tax holiday. Or we have sections deductions from that particular heading, which is profit link deductions from 80 IA series and all, IA, IBIC, etc. So we have these sections, right? And these give major benefits to the assessee. See, what is 10AA? You all know that it gives for 15 years, it would be a tax holiday. First 5 years, 100% of the profits. Next 5 and next 5, 50% of the profit. Last 5 is 50% of the profit with some conditions, right? 10AA also we will revise in some other class. Okay. So 10AA, people take a good deduction. 80 IA, 80 IB, 80 IC, almost your profits, all your profits, you get deductions. So what happens is, let's say for example, there is an assessee. Let's say there is X Limited. X Limited has 2 units. One unit was in SEZ, Special Economic Zone, and the other unit is not in SEZ. Let's say it was in DTA, domestic. You all understand what is DTA now? Domestic tariff area, means normal India. It's non-SEZ, like normal India. So basically, right now where I am sitting, where you are sitting, might be in DTA only, right? So SEZ. So SEZ, let's say for example, this unit, you understand, in first 5 years, 100% profits are exempt, right? And in next 5 years, 50% of the profits are exempt, and so on. So let's say even this is the P&L account of this unit. This is the P&L account of DTA. They know that in DTA, they want more and more expenses. Why they need more and more expenses? So that actually they can pay less tax. And here, even if the income is higher, they know that they will get the deduction. Let's say when they're in the first 5 years, 100%, next 5 years, 50%, and so on, right? So they know that they will get a deduction over here. So what they will do is, whenever they do transactions between each other. One unit, they are just one SSE, and they are doing transactions with each other. Inter-unit, this is called inter-unit transactions. So when they are doing inter-unit transactions with each other, so let's say for example, he is selling something. He is making a sale. So SEZ unit is making a sale, which was supposed to be the market price. The price should be, let's say, 10 crore, but they were making it at 30 crore. They were making it at 30 crore. I'm changing it. Let's say they are making it at 40 crore. So the correct value was 10 crore, but they were making it at 40 crore. Why? So that whenever they will record, they will record at as a purchase how much? 40 crore. They have inflated their expenses by how much? 20 crores. They have by 30 crore, sorry, because the correct price was 10 crore, but SEZ unit has shown it at 40, and they have shown it at obviously 40 purchases. They have inflated their expenses by 30 crores. So on this also, we will apply the transfer pricing provision. We will say, no, it is not 40, it should be 10. So if this should be 10, this should also be 10. Correct. So on this also, we will apply the transfer pricing provision. And is very, very important point, these specified domestic transactions, the aggregate during the year of all the specified domestic transactions which you have made, the aggregate of this, of all the transactions, specified domestic transactions which you have made, if it exceeds 20 crore, then only transfer pricing provisions will be applicable. If it does not exceed 20 crore, leave it. If only, this is very important, if the value of the total transactions, total specified domestic all the specified domestic transaction SSE which you have undertaken, if the value exceeds 20 crore, then only please apply TP provisions. Otherwise, do not apply. Otherwise, these are not specified domestic transactions. We will leave it. Got it? Now, same way, if it is inter-unit transfer, transaction provisions can be applicable. Also, if it is, let's say, for example, you are doing transactions, let's say, one enterprise, the assessee is also different. This is X Limited and this is Y Limited. This is X Limited, this is Y Limited. And let's say, for example, they are closely related to each other. They are linked with each other. They are sister concerns, right? They are related with each other. So what they will do, let's say, for example, X Limited is taking some deductions of 80IA, IB, IC, etc. Let's say they are taking deductions and they are not eligible to take the deduction. So what will happen? They will again make a sale at a higher value and they will purchase at a higher value. And what they will do, they will show more and more their expenses, and more expenses they will show. They will also save their taxes, and they are so already saving it under 80IA, IB, etc. Right? So specified domestic transactions can be inter-unit also, same assessee, different units, or it could be inter-assessee also. It could be inter-assessee also. So all these transactions, these are mentioned in section 80A also, that if you do these transactions, what it is? Inter-unit. Inter-unit means same assessee. The assessee is same, and you are doing inter-unit transactions, what I am writing. Okay. And it can be with different assessees also. It can be with different assessee also. But if they are closely connected, with each other, then this transaction would be attractive. Also, we know now there are some new companies, right? Those who can claim, those can take the benefit of 115 BAB. What is 115 BAB? Sir, these companies can take the tax rate at how much? 15%. Other companies 25%, 30%, right? So these companies can take 15%. So let's say there is one company, A Limited. They are getting taxed at 15%. There is another company, B Limited. B Limited has a tax rate of 25% or 30% as the case may be, right? So this is higher tax, this is lower tax. So what they will do? They will do transactions between each other. They will again do transaction between each other, and whatever transaction they will do, it will record. Let's say, for example, this is selling something. So again, they will record at higher value. They will record at lower. They will actually record the purchases at higher value. So what will happen? Again, they are booking their expenses more than the ALP. Transfer pricing provisions will applicable over here also. And then later what they brought is, because we have a similar section BAB, we have a similar section in cooperative society. Do you remember this? What was the section number? You know it? 115 BAE. Same, cooperative societies enjoy 15%. Other cooperative societies are giving normal tax rate. So what they will do? They will actually transaction between each other, and they will save their taxes. So all these transactions have been given the name specified domestic transactions. And if these transactions, all the transactions, last is any transaction as prescribed by the board, right? Any transaction as may be prescribed. So all these transactions, if the aggregate value of these transactions exceeds 20 crore, all the transactions which the assessee has undertaken, right? Not each one, no. If assessee has undertaken any of these transactions, then we will do the aggregate of it, and if aggregate exceeds 20 crore, transfer pricing provisions would be applicable, right? So first it is written any transactions referred under 88. Under 88 is this is the only thing written, inter-unit and the closely connected enterprises. So transfer of goods or services referred under section 80 IA. IA 8, you don't have to remember the subsection number. IA 8 and IA 10. IA 8, what is written? Inter-unit, same as the inter-unit. One of the unit is taking 80 IA deduction, other unit is not taking. So they will do transaction between each other. 80 IA 10, what it is written? Closely connected. Different assessees, but they are closely connected. So these, and not only 80 IA, all these similar transactions which the assessee is taking deductions under 10 AA or any other section of chapter 6, 80 IA, IB, IC, etc. Or where one of the assessee is taking the advantage of 115 BAB. What is 115 BAB? Companies 15%, or 115 BAE, cooperative society 15%. Then also we will apply the specified domestic transactions. These are specified domestic transactions. We will apply ALP. We will apply the transfer pricing provisions. And if we will apply the transfer pricing provisions, provided the total value, this is very important, please don't make a mistake over here, provided the total amount exceeds 20 crore. If the amount is not exceeding 20 crore, no requirement to apply the transfer pricing provisions. Understood? Okay. If you are undergoing, if you have done international transaction or specified domestic, it is for both, guys. If you have done either international transaction or you have done specified domestic transaction, guys, you have to maintain certain records. You have to maintain certain records. Correct? You have to give me a moment. See, it is written over here. Assessee entering into an international transaction or even specified domestic transactions are required to maintain the prescribed records. See, you don't have to submit the records. One of the record is a master file that I'll tell you that you have to submit it with the ROI. But generally, the documents which you maintain, which is called TP study report, you don't have to submit it with the return of income. See, it's same like whenever you are doing a business or profession in PGBP, you have to maintain your records. Correct? Now, 44AA says that if the conditions are satisfied, you have to maintain the records. Do you submit those records with the return of income? The answer is no. Today, the return is paperless return. The same way, you have to maintain the records. Section 92D, very, very important section. If you remember the section number, it's okay. It's also fine. But the thing is that you should know that we have to maintain the records, and we don't have to submit it with the return. But if they will ask, if the assessing officer or the CIT appeal will ask that please submit your documents, then we have to furnish them. If we will not furnish, then we will have to pay penalty also, right? So whenever they will ask, and let's say, for example, we have not maintained it, or we have maintained it, but we don't furnish them, then we have to pay penalty also. That we will be doing also the penalty, right? Now, guys, very, very important. You have to preserve these records for 8 years. You have to preserve these records for 8 years. So documents must be maintained for a period of 8 years from the end of the relevant assessment year, right? Both for international transactions, specified domestic transaction, please preserve the record for 8 years. Now, I'll be telling you some more points about this, but which are more related to international transactions. Specific domestic transaction is very easy, that you have to maintain the record. But for international transactions, you have to actually give the information, not only for the transaction which is happening, but also related to your group, international group to which you belong to. First of all, let's understand this. See, there are three tiers of records which you have to maintain. One is we are doing section 92D, which says that you have to maintain records. So what they are saying in 92D, they are actually telling us two things. That first of all, you need to maintain local files. You don't have to submit it with the returns, but yes, you have to maintain it. And if you don't maintain it, we will actually levy penalty. You have to maintain local files. This is also known as TP study report. TP, transfer pricing study report. This is what, see, the name itself is saying local file. What is local file means? What would be the local file meaning would be that whatever the transaction which is happening, so related to that transaction, you have to maintain the record. Correct. Second thing that you have to, this is for international transaction, guys. This is not for the domestic transaction. This is for international transaction, that you have to file master, you have to furnish master file also. What is master file? I'll explain you in detail. That you have to furnish master file. When you have to furnish with return of income. It is mandatory. It has actually two parts. It has two parts. Part form, this form number, you don't have to remember any of the form number, but whenever you furnish master file, there are two forms, part A of the form and part B of the form. Part A contains it will contain just an overview, very high level information, not detailed. So this is mandatory. Master file part A is mandatory, that you have to furnish it with the return of income. Part A is mandatory. Part B, if you actually satisfy certain conditions, if you are actually part of a big international group, then part B would be required. Otherwise, part A is mandatory. See, part A, though, everybody has to file. Every international transaction, every person who is here, associate enterprises, they have to file part A. But part B is only for some big international group, they have to furnish it, right? So there are some conditions. There are some conditions related to revenue and some value of international transactions that I'll be discussing it. So as of now, section 92D deals with that you have to maintain books of account. This you have to maintain, but this master file part A you have to furnish mandatory. Part B, if conditions are satisfied, then you have to furnish, otherwise not required. And when you have to furnish it, by ROI. If you don't furnish it for master file, the penalty is 5 lakh rupees, guys. If you don't furnish your master file, the penalty is 5 lakh rupees. Okay. What is the penalty for this? I'll tell you. 2% of the value of transactions. I'll tell you. Okay. Now, first of all, local files. Local files you have to maintain. You don't have to give it with the ROI, but whenever it is asked, then you have to give. So first it says that 92 days says documents must be maintained for a period of 8 years from the end of the relevant assessment year. First is transfer pricing study report, TP study report we call it, or local file. If any document is called by the assessing officer is doing your assessment, he can call these documents. Or CIT appeal is actually, there is a case with the CIT appeal, they can also ask for the documents. So whenever AO or CIT appeal during any proceedings, whether it is in assessment proceedings or appellate proceedings, then it should be submitted within 10 days. So as in when they will call it, so please, you should be ready with your documents. You have to give it within 10 days, or they can extend it this further period to 30 days. So 10 days from the date of receipt of notice, it can be further extended to 30 days also, right? So 10 days, little bit important. If this is very important, this file you have to maintain only if your value of transactions is more than 1 crore. Again, 1 crore is again repeated over here. See, 1 crore we have done in secondary adjustment. Here also there is a limit of 1 crore. So if your value of transactions is exceeding rupees 1 crore, whether it is international, whether it is specific domestic transaction. See, specific domestic transaction will not work over here. Why? Because there the transaction is more than 20 crores. Obviously, their transaction is more than 20 crores there. But here, even your international transactions exceeds rupees. See, obviously, if your value of transaction is exceeding 20 crores, so there so always you have to maintain this TP study report. But in international transactions, if it is more than 1 crore, right? So commonly you can understand it 1 crore, because there it is obviously more than 20 crore, then only specified domestic transactions, it will fall under the category of specified domestic transaction. Okay. So above documents are required to be required if the value of transactions is not more than 1 crore, not required, but if it is more than 1 crore, then it is required. And there is a penalty under section 271 AA. No need to remember the section number, but guys, this penalty you should remember. This penalty is quite important. 2% of the transaction value, 271 AA. If you don't furnish the master file, then 5 lakh. Sir, it is also 271 AA. It is also 271 AA. You don't have to remember, but actually it is subsection 1 and this is subsection 2. See, if you will see, I have also given the penalty separately. These are the ones. See, 271 AA. So failure to keep and maintain the documents under section 92D. So if you don't maintain your books of accounts, there are other penalties also, but as of now, just read this. 2% of the value of the transactions, 2% of the value. And value of which transaction? Value of actual price or value of ALP? Obviously value of ALP, right? So it will not be actual price could be very less, but we will actually charge 2% of the ALP, right? And if you do not furnish the master file, then 5 lakh is the penalty. See, 271 AA, same section, but it is subsection 1, subsection 2. Please don't learn that. This much is not required, but yes, this is important. Correct. So these we have done. Okay, come back. Now, this is the TP report that you have to furnish. This is the local file. Second is the master file. And obviously it is an international transaction. So purpose, why we require a master file, guys? Actually, after master file, we will see that there is another section 286. 286, very, very important section, 286. CBCR. You might have heard this name, CBCR. See, country by country reporting, CBCR. So actually what OECD BEPS action plan, what they have said that we want information. We want information not only about the taxpayer who is there in the country, but we need information for the entire international group. Why they need for the entire international group? See, understand it. Let's say, for example, let's say, for example, there is a company in India, right? There is another associated enterprises in US. There's another associated enterprises in, let's say, Singapore or Mauritius, right? And we have to actually, what the BEPS plan, what OECD, you understand, although we have a separate chapter for BEPS action plan, but for, let's say, BEPS action plan has said, BEPS, base erosion and profit shifting, they have said that actually it's a global, right? It's a global international organization. So what they have said to all the member countries that was, please take the information of the entire international group so that you can get the correct picture. See, let's say, for example, in US, they are showing, let's say this is part of all, this is actually an international group. One of the, let's say, company or their concern is here in India. Second concern is in US. Third concern is in Mauritius. So this is part of international group. So this is called as international group. Guys, what I am teaching you master file also and CBCR also side by side, so that you can actually relate it. So this is called international group. International group. And what are these called? These are the part of this group. So we call them constituent. We call them constituent, right? So in India, there is one constituent. There can be more constituent in India also, right? There can be 2 companies, 3 companies also. So in India, let's say I'm keeping it simple. Let's say in India, there is one constituent. In US, there is one constituent. Mauritius is one constituent. These are the parts. And let's say, for example, they have a head office in US. This is the head office. So this is a constituent also, and it is a parent company also. This is the parent entity also. This is the parent entity. Understood? So they all are constituent also. So this is only constituent, not a parent entity. Mauritius is only a constituent, not a parent entity. US, the company is a constituent also, but it is also a parent entity, right? Constituent means part. Obviously, this is one of the part, this is one of the part, this is one of the part. Now, what a master file says, that master file is just an overview. CBCR is actually detailed. CBCR is actually detailed. So what it is, they are saying that please give the information. Let's say, for example, in India, you have to give the information about your transaction also, that is covered in local files, but you have to give some certain information of all these people. You have to tell us that what is the revenue of all this. Let's say for example, they are here. They are saying, I'm telling you in the denomination of Indian rupee. Let's say, for example, in US, they say that our revenue is 40 crores. In India, they say that our revenue is, let's say, 20 crores. And in Mauritius, they say that their revenue is 500 crores. Okay. In Mauritius, significant revenue. Okay. Tell us about the revenue. You told us. Tell us about the employees, let's say. So let's say, for example, in US, there are 200 employees. Okay. In India, there are 800 employees. Okay. And in Mauritius, 2 employees. How can it be possible? Now, because earlier when OECD, BEPS action plan were not there, so people were actually taking the advantage. They were not showing this. They were not showing this. They were just showing the local transactions. They were not actually showing the true picture. Now, guys, as soon as I will say that here the turnover is 500 crore and only 2 employees are there. It is just for a namesake. And here 800 employees are there and the revenue is 20 crore only. Why? So you will actually, there is a question mark. You will ask some questions. So that is the reason now there is a concept of master file also and CBCR reporting also. So what OECD member has done is that whatever the OECD has actually given the guidelines by BEPS action plan, all the countries have incorporated that plan into their own country law. Same with India. So what India has done, India has adopted that BEPS in their own Indian law. So they have actually made a section 286 of CBCR also. And the same thing is here in master file also. So now in master file, let's say in part A, you have to give us a rough, brief idea that tell us about your international group, tell us about their revenue, right? And very, very overview, very high level things you have to tell us, right? But if you are a big international group, then you have to furnish part B also. Understood? Now, they are saying, so what is the purpose of the master file? To provide a consolidated overview so that we can get a consolidated overview of your international group, of the multinational enterprise, so that we can get the international group overview about their global operations, about their organizational structure, about the assets which they have, tangible, intangible, about their transfer pricing policies, which are aligned to OECD BEPS initiative. So this is what is the purpose is. Now, that is the reason they said that master file you have to furnish. You have to furnish the master file to the Joint Director of Income Tax. So furnish master file to the Joint Director of Income Tax up to when? Up to the due date of ROI. Form number A is mandatory. Form number B would be applicable if you satisfy certain conditions. So form number 3C AA, no need to remember the number, not required. You have to furnish before the due date of ROI. It has part A, part B. Part A is mandatory, whereas part B is subject to prescribed limit. So what are the prescribed limit? So here I have given that the constituent entity. Understood? So let's say in India, we have one of the constituent entity. So this constituent entity has to furnish this master file. Let's say in India, we have more than one constituent entity. So out of them, only one will furnish. We don't need duplicate information. Obviously, we don't need duplicate because your international group information would be same. So obviously, let's say, for example, you have one constituent in, let's say, in Coimbatore, one in, let's say, in Bangalore, one in Hyderabad. So all of them don't have to furnish the master file. Only one of them have to furnish it. Okay. Constituent entity of the international group shall furnish on or before the due date the master file. Part A, mandatory. Part B, if the condition is satisfied. What is the condition? Part B is required if the following conditions are satisfied. What are the conditions? First of all, the consolidated group revenue. The consolidated group revenue. Understood the group? The consolidated group revenue is more than rupees 500 crore of the year. So we are using the word accounting year because the previous year or the assessment year, we cannot use it because actually it is taken directly from the OECD. The wordings which we have used is directly taken from the OECD BEPS section plan. So that is the reason we have used the word accounting year. Correct. So consolidated group revenue for the accounting year if exceeds 500 crores. So if, let's say, for example, this is a small international group with a turnover of total consolidated revenue less than 500 crore, then part B is not required. Part A is only required, part B is not required. But if it has a consolidated group revenue more than 500 crore, then the part B is also required, plus, 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 plus. This is the first part. Second, the aggregate value of international transaction plus, see, if it is more than 500 crore, plus the aggregate value of the international transactions during the accounting year exceeds 50 crore. So let's say if the consolidated group revenue exceeds 500 crore, but the value of transaction is not exceeding 50, then part B is also not required. So both the A and B should be satisfied. Actually, B has 2 points. So out of any one can be satisfied. So A, either A plus B1 or A plus B2. Understood? So B1 and B2 is out of 1. You have to satisfy it. Or transaction of intangible property during the accounting year exceeds 10 crore. So either could be 500 crore group revenue plus 50 crore value of transactions. Okay, you have to furnish part B also. Or let's say more than 500 crore group revenue plus more than 10 crore the transaction of intangible property during the accounting year. Got it? Guys, this actually institute has not yet asked so far. So you should have a idea of it. Might be they can ask because the type of paper they are giving, so anything can be asked. So we cannot leave anything, right? We cannot leave anything. But still, I feel that they should not ask this. But see, my gut feeling will not help now because they can give anything. So I'm not making the paper, right? So it's better to do everything. Since we are doing in detail, so it's better to do everything now. And I believe that you are all understanding whatever we have done so far. I believe that you all understanding it. Guys, please do let me know in the comment section that how you are finding the classes. What are extra things which you require so that I can help you for your examinations? What are the things which you require? Please tell me. Unless and until you don't give me your opinion, I'll not be able to understand that what else is your prime chapter which you are thinking that here we are finding difficulty, here we can need more explanations, or here we need more questions. So please do let me know. At least give me comments, right? At least tell me that how you are actually finding these lectures. Okay. Now, section 286, country by country reporting. What is the CBCR? Now understand, guys. First of all, what is the due date of CBCR? Once the year is ended, 12 months from that. So 12 months from the end of the relevant year, right? So we will use the word accounting year again. So due date of CBCR, 12 months from the end of the accounting year. Let us understand what is CBCR. Okay. So let's say, for example, this is, I'm taking the same example, which I have given it in the book also so that you can easily relate. Let's say, for example, this is, okay, let me take it from here. Let's say this is Siemens, Germany. It is the head office. It's a parent company. They have their constituents in US, Siemens USA, Siemens France, Siemens China, and Siemens Limited India. India is also here, right? So this is an international group. And tell me who is the parent entity? Siemens AG, Germany is the parent entity. And who are these constituents? 4 constituents, or this is also constituent? This is also constituent as well as the parent entity. So there are 5 constituents. Now, guys, the OECD web section plan says that the parent entity, ideally, the parent entity should submit a detailed report of the entire group. They have to send us the detailed report of the entire group. They have to furnish in their home country. So Siemens Germany has to furnish the detail in their home country. The home country would be Germany. And the German government, the German income tax authorities will actually share this report with US government, France government, China government, and Indian government. So whether Siemens India is required to file CBCR? Generally, no. Why? Because Siemens Germany will file. It's obviously the report, all the transaction would be same, the data would be same. So Germany would be filing in their own country, and their country would be actually sharing this information with us, right? First thing. Let's say, for example, Germany, let's say due to any reason, Germany is not furnishing it. Then Germany can, what they can do, they can actually designate one of the alternate entities. So the alternate entity can be US, alternate entity can be France, alternate entity can be China, or alternate entity can be India. Let's say, for example, Germany designates Siemens US that in this year we are not filing, you file on our behalf. So what will become? Siemens USA will become alternate entity. Got it? Alternate entity, and they will furnish in US, their home country, and US government will share with everyone. And Indian authorities will also get it from US. Understood? What is parent entity? What is alternate entity? So example number one, parent entity is Siemens AG, Germany, is required to submit CBCR in their residence country, that is Germany. Or let's say they don't want to do it, they can designate any other person. So they can designate any other person, which is called alternate reporting entity. So let's say Siemens Germany designate its constituent entity, any of the constituent entity they can designate. Let's say they designated Siemens USA to submit CBCR in USA on behalf of Siemens Germany. Correct. Now, what is Indian Siemens is required to do? Indian Siemens should tell us, give us the intimation. They are not filing CBCR, but actually they should. First of all, they have to file master file. That is for sure. At least part A they have to file. Part B depends on the revenue and plus the value of transaction. So first of all, they have to file master file. Though for sure they have to file. Second thing, they have to give a declaration. They have to intimate to us that who is filing CBCR, who is filing CBCR, whether Germany is filing, whether Germany has actually appointed some other alternate entity who is filing, or let's say, for example, you are filing, who is filing. So give us the intimation. So what is constituent entity in India is required to do? So we are concerned with India. So constituent entity Siemens Limited in India is required to. What they are required to do? Two things. First, obviously, master file they will furnish, right? Otherwise, the penalty is how much? 5 lakh rupees. Furnish the master file as per section 92D. And what is the due date for the master file? Due date of ROI. Same. On or before the due date of ROI, file it to the Joint Director of Income Tax as designated by the Director General. Director General means what? Same rank as Chief Commissioner. Okay. Then furnish an intimation. Master file, so you have to do. Then furnish an intimation that who is filing CBCR. Germany is filing, or they have appointed any other alternate one, or you are filing, you yourself. Might be India, Siemens India might be the alternate entity. So furnish an intimation at least 2 months prior to the due date of CBCR reporting. Now tell me, what is the due date of CBCR reporting? Sir, when the year got ended, after it 12 months. So it is CBCR we have done now. What is the due date of CBCR? 12 months from the end of the accounting year. So accounting year means previous year. So previous year 25-26, it will end on 31st March 26. From here 12 months. So 31st March 27, this is the due date for CBCR, right? So before 2 months before this, before 2 months before the due date, that is by which date? 31st January 27. Got it? Again repeating. What is the due date of CBCR? It is when the previous year account, we are calling it accounting year, but actually it is previous year. When the previous year ends, previous year 25-26, when it will end? So it will end on 31st March 26. From here, how many days are there? One year. So from here 12 months. So what it would be? 31st March 27. This is the due date of CBCR. You have to give us the intimation 2 months in advance. Obviously, this is the due date of CBCR. So please at least tell to the income tax department that who is filing CBCR, whether Germany is filing, whether US is filing, whether you are filing. So please give us the information. Furnish an intimation at least 2 months prior to the due date of CBCR, stating that whether it is the alternate reporting entity of the international group, whether you yourself, Siemens India, are you the alternate reporting entity, or who is filing, or parent entity is filing, or any other US is filing. So please let us know 2 months before, right? I'll give you second example. Second example is more interesting. Why? Because here Indian company is the parent entity. So Infosys Limited India, they have constituent. So this is one of the international group constituent, and it is also the parent entity. Infosys UK, Infosys Germany, Infosys Australia, Infosys Technologies Chennai. Now, Infosys Limited India, your prime responsibility is that you will file your CBCR. Till when? when the year will end, after that 12 months, right? So you have to file your CBCR, provided the total group revenue is more than 6,400 crores. So earlier it was something else. It was 50. Forget about it. I'm not telling you unless you will get confused. Now you have to learn this. So if the consolidated group revenue of the last year is 6,400 crore or more, is of the last year is 6,400 crore or more, then you are supposed to do the CBCR reporting. Who will do? India Infosys Limited will do, and within same, within 12 months from the end of the accounting year, right? Guys, what is the details of CBCR? So I have given you that, guys. It's very important. In fact, see, once you will qualify, or might be some of you who have done your articleship, and especially in direct taxes, specifically with those firms where you do your international taxation work. So they might be knowing it, that CBCR reporting is today actually quite important. If you are going for international taxation interview, then obviously the one thing which they will ask for sure is, do you know how to file CBCR reporting? And it's easy. It's not difficult. Those students who already know, they know that it's not very, very difficult. See, everything is, obviously we are chartered accountants, so little bit it would be complex, but it is not very difficult, right? And the students who don't know, it doesn't matter, guys. It is very easy. You will learn. So details of CBCR. What is the details required? See, we need a detail of your revenue, how many employees are there, what is the capital employed, your tangible assets, your intangible assets. So we need detail of everything. So why? Because today all the countries should have the same information, right? So you cannot actually manipulate the transactions in one country and in another country you are showing something else. No. So today everyone, OECD has done such a good thing that today everyone is on the same page. So the amount of revenue, profit before tax, how much is the income tax you have paid in each country, and how much still is outstanding, how much is accrued, details of your capital, accumulated earning, number of employees. No need to learn, guys. No need to learn. CBCR, they have not asked yet, but any time they can ask. So you should have an idea of it. So what is the revenue, profit before tax, income tax paid and accrued, details of capital, what is the accumulated earning in each country, number of employees, tangible assets, nature and details of the main business activity in respect of each country. So what is the revenue in each country? What is the profit before income tax in each country? What is the income tax paid or accrued in each country? How many number of employees are there in each country? So in respect of each country or territory, along with details of each constituent's incorporation country and residential status. This shall be based on the template provided by BEPS report on action plan number 30. Right. Now, this is something little important for exam. This can come in examination, guys. This can come in examination. Let's say, for example, I'm taking this case. For example, let's say here, Germany is supposed to file CBCR, right? Germany is supposed to file CBCR, right? See, in India, obviously it is required, but if Germany is filing, so we'll get it from there. But let's say the obligation of Indian entity will arise if there is no CBCR provision in the parent entity. The person who is actually supposed to report CBCR, there is no CBCR provisions there. Means that is not that country is not part of OECD member group. So in that case, you are required to file the CBCR, right? Or let's say, for example, Germany is, although we have DTAA with Germany, but still, let's say Germany CBCR reporting compliances are there. So let's say they have filed CBCR. Siemens Germany has filed CBCR with the German authorities, but we don't have the exchange agreement. We don't have that DTAA with Germany. We have it, but let's say, for example, just for example, so if we don't have the exchange exchange agreement, or we don't have the DTAA with them, so obviously we will not be able to get the report. So in that case, this person is supposed to file the CBCR. Got it? Again repeating, if in the home country there is no CBCR law, then obviously Siemens India, in India there is a law, so Indian entity has to file the CBCR. Or let's say there is a law, but we don't have an agreement with them. We don't have an agreement with them. So obviously then Siemens India Limited has to do it. Third point, very important. Let's say there is a law also, and we have the exchange agreement also. We have DTAA also with them. But still, due to any reason, they are not giving the information. Right? Generally, it is an automatic sharing of information if we have DTA. But due to any reason, let's say they are not sharing the information. We have DTAA with them. We have the agreement sharing with them, but still they are not sharing it. This is known as systemic failure. This concept is known as systemic failure. That they have submitted CBCR in Germany. We have agreement also to share the information, but still it is not being shared. That's called a systemic failure. Then if systemic failure will happen, then they will have to submit the CBCR. And how they will know that's a systematic failure? Because they might be thinking that, okay, Germany will file and we have DTAA with Germany, so our government will get the information. So how they will be able to come to know? So this person will get the information from the joint director. Joint director will actually give them notice that actually systemic failure has happened. So somehow we didn't get the information from Germany. Now you have to file the CBCR. Obviously, then they will be provided date from the day when they will receive, Siemens India will receive the intimation from the joint director. This point is important. CBCR report in exceptional cases. So resident constituent entity in India, Siemens India, is also required to furnish CBCR if the NR parent entity is from a country. If the NR parent entity, let's say Germany, is from a country where there is no CBCR law, where there is no obligation to file CBCR report, okay, then India knows now that there is no, Siemens India knows now that in Germany there is no law. So they have to furnish the CBCR within the same time, within 12 months from the end of the accounting year, because they know prior to this also, now they know it that in Germany there is no law. So it is a public information, right? You already know it. So same date you have to file the CBCR, 12 months from the end of the accounting year. With whom India does not have an arrangement for exchange of CBCR report. Let's say, for example, in Germany, there is a CBCR law. Siemens Germany has filed the CBCR in Germany, but we don't have the exchange agreement with them. So with whom India does not have an arrangement for exchange of CBCR report, then also you are under an obligation to submit. Will you get any intimation from somewhere? No. You all know that we don't have a DTA with this country, let's say. So it's your responsibility to furnish your CBCR. But the third point is that we have the exchange information, but still it is not being shared due to any reason, which is called systemic failure. Then you will get the intimation from the department. Once you get the intimation, please submit your CBCR. So with whom India has arrangement for exchange of information. Although we have the DTAA with them, we have the exchange agreement with them. However, such country is not exchanging this information. This is known as systemic failure. Got it? This is known as systemic failure. So now Siemens India, you are in an obligation to furnish CBCR within 6 months from the end of the month when systemic failure was intimated to you. So who will intimate? The department will intimate that there is a systemic failure has happened. From the end of that period, from the end of that month, you will get 6 months to file the CBCR. Got it? And obviously, this is not that important. If there is more than one constituent entity in India, let's say if we have in India, let's say one is Bangalore, one is Mumbai, one is Delhi, so only one of them have to do it. So in case more than one constituent entity in India, then the group can nominate one constituent entity for filing the CBCR report. Only one of them has to intimate. We don't want duplicate reports. Right? You don't have to remember the form number, that you will furnish a form number that to whom you are designating. Right? Whether to Delhi office, whether to Mumbai office, whether to Chennai office. And please tell me, verification of income tax authorities. See, what happens is, let's say, for example, you have filed your CBCR. You have filed your CBCR. Now, please tell me, the income tax authority will verify also now that whatever the report which you have furnished in CBCR, is it the correct information or the wrong information? So we will verify that income tax. We will verify that. And to verify that, we can ask some more information from you. We can ask certain more documents. We can ask some more evidences from you also. So verification by income tax authorities. Joint Director of Income Tax can call for such documents or information from the entity furnishing the report for the purpose of verifying the accuracy. So we won't like to, you have furnished CBCR, very nice, you have furnished CBCR. The chartered accountant has helped you to furnish CBCR. Obviously, they will only help. Then, but we need to check the accuracy of it, whether the information contained in that CBCR is correct or not. Then they can actually, the department can ask you, the Joint Director of Income Tax can ask you that please furnish some more documents. The entity is required to furnish such document or information within 30 days of intimation. It can be extended further to 30 days. Correct? What would be the penalty? What would be the penalty if you don't furnish CBCR? Two things. Two things can happen. You are required to furnish CBCR, but you have not. See, what is the penalty for master file? 5 lakh. Okay. If you don't furnish CBCR, what is the penalty? Second, you furnish CBCR, but you are not giving the information so that we can check the accuracy, then there would be a penalty. Correct? So there are penalties under 271 GB. No need to remember the section number. It says for non-compliance in CBCR reporting, if you don't comply with the CBCR reporting, what you does is you don't furnish CBCR report. You were actually required to furnish CBCR report, but you didn't furnish it. So within the first month, the amount which you have to pay is 5,000 rupees per day. Quite heavy. So for the first month, if you, let's say, furnish within a month, then 5,000 per day. If you furnish after 1 month, so for the first month, it would be 5,000. But for beyond one month, it would be 15,000 per day. Correct? So let's say, for example, if someone furnishes after 40 days. So first month, let's say 30 days into 5,000. And beyond 30 days, 10 days into 15,000 per day. Quite a big penalty, right? So this is the penalty. And if beyond 1 month, 15,000, let's say, for example, we have intimated to you that, boss, you are supposed to pay penalty and still you are not paying penalty. So continuing default, even after service of order of penalty, we have served an order on you on penalty also, and still you are not furnishing it. Then once the order is received by you per day from the date of service of order, once the order is served on you, from that day, 50,000 per day. Understood? First 30 days, 5,000 rupees per day. Beyond 30 days, first 30 days, 5,000. Beyond, 15,000. And once the notice is given to you that this is the penalty, the order of penalty is also served on you, still you are not paying your penalty. After that, 50,000 per day. Great. This is the penalty for non-furnishing CBCR report. Then, if the joint director has asked you to furnish the information, why? Because he needs to check the accuracy, and you are not furnishing that information. Not furnishing the required documents or information when called by the joint director of income tax. You fail to furnish the documents of the information within the time allowed. So how much time they will give you? 30 days, which can be further extended to 30 days. If you submit within time, then good enough. If you don't submit, then from that expiry of those 30 days or extended period, from that expiry, 5,000 per day. And if again you continue the default even after service of order of penalty, then it will become 50,000 per day. So till that time, 5,000. After service of penalty order, still you are not doing it. After that, 50,000 per day, right? And if you furnish incorrect information in CBCR report, 5 lakh would be the penalty, right? But however, in case of reasonable and genuine, if you have genuine reasons, and if the joint director is satisfied, then what will happen? No penalty in that case. No penalty in that case, right? So this was CBCR reporting, guys. Not, if you ask me, if I see the previous trends of the examination, they have not asked much about on CBCR, but we never know from where the examiner will ask. So please be ready for everything. It's not difficult, guys. It's not, I'm telling you, it's not difficult. Just you have to understand the concept once. Then revision will not take much time. See, I have taken this transfer pricing. It's been now, this is the third and the last part of transfer pricing. But I'm telling you, if you will be revising transfer pricing, now after this, if you will be revising once again, just look at the notes and you will be revising it. Even if you're doing question, you will be able to solve everything within 2 hours. And third time, if you will revise it now, within 1 hour, you will be able to solve. I'm telling you. And after third time, actually, after third revision, actually, the things gets into our mind permanently. Correct? Okay. 92E is very easy topic. So what is this? This is the transfer pricing audit report. So this is the report by the chartered accountant. So whenever you are entering into either international transaction or specified domestic transaction, it is mandatory that you have to furnish your TP audit report also. And by which date? Obviously, all the reports which are furnished by the chartered accountant, it is 1 month before the due date. So if your due date is 30th of November of ROI, so 1 month before that, it is 31st of October. So every person who has entered into either international transaction or specified domestic transaction shall obtain a report from a chartered accountant and furnish on or before 31st October. That is 1 month before the due date of ROI. Same way, the audit report we furnish 1 month before. Here also we will furnish the TP report also 1 month before the due date of ROI. Correct? Okay. If you do not furnish the audit report, then what will happen? There is a penalty of 1 lakh rupees. Right? If you do not furnish the audit report, so this says section 271BA says, no need to remember the section number, but this is important. If you do not furnish the audit report, then the penalty would be 1 lakh rupees you have to pay. Okay, sir. Now assessee would be very happy. Sir, we will pay 1 lakh. Will not furnish the audit report, will not show the international transaction. No. This is the extra penalty. See, if you do not furnish your international transactions, or if you furnish it wrong, then actually there is a penalty of 2% of the value of the transactions also. So this is not just like that just pay 271BA 1 lakh rupees and you don't have to pay anything. No. Failure to report the transaction in TP report. If you fail to report the transaction, there is a penalty of same 2% of the value of transaction. And value of transaction of what? Actual price or ALP? ALP. Or failure to maintain or furnish the correct information, 2%. Correct. So this is in addition. It's not like that either you do this, either you pay this. No. This is in addition to this. Correct. Failure to furnish master file, we understand 5 lakh rupees. Failure to furnish the documents, we have done this, that whatever the documents, failure to furnish the information documents when called by APO as mentioned in 92, 2% of the value of the transaction. Correct, got it? And also 270A, the old section, which is very, very common in most of the thing whenever there is underreporting, misreporting of income. So how much is the tax can go? 200% of the tax on underreported income. 200% of the tax of underreported income. So let's say, for example, if you have misreported your income, it is by way of fraud, right? If you have misreported or underreported your income, then it would be 200% of the tax on underreported income. Got it? But let's say if you have not misreported, you have shown everything in your records, you have shown everything over there. However, we have determined the ALP little higher, but you have shown everything over here, then we will not levy this penalty. Got it? So this was about penalties. So let us talk about notified jurisdictional area, guys. Now let us understand the concept of notified jurisdictional area in section 94A. We'll be doing one more section now. Only one more section is left 94B, which is related to excess payment. But before that, let us do notified jurisdictional area, NJA. First of all, understand the concept of NJA, which is very, very easy, and examiner ask on this topic. See, section 94A, which is related to NJA, notified jurisdictional area. What is NJA? It is such a country or a territory. It can be a country or it can be a territory which generally does not share information with India. So what's happening here? Indian government will not be able to know. So they don't share information with India. Their banks, if they have banks in their territory, they will not share the information with us. So let's say if somebody has kept his black money over there, we will not be able to get the information. So that particular country or territory is known as NJA. Is there any NJA right now? The answer is no. As of now, at present, there is no NJA which is declared by the government. But yes, in the past, there was one NJA. If you have heard about the country, which is named Cyprus. So Cyprus was, once it was declared as an NJA by Indian government, but later on they apologized it. That sorry, and they have actually given a written apology. So after that, we have said, okay, Cyprus, you are also not an NJA. Okay. So today there is no NJA. So practically there is no NJA right now, but still examiner asks question on this. See, now what happens is, I'll tell you a background. See, what was happening is, let's say for example, people used to have their black money earlier. They used to have their black money in the Swiss bank, right? Switzerland. So people used to have the money in Switzerland. Now, when the Indian officers, when we had the DT agreement with the Switzerland, then the Swiss bank were supposed to give the information to the Indian authorities. So, to the surprise of Indian authorities, when they have asked for the information that what is the, who are your account holders, give us the information if they are Indians. So we found that the people of India were having their accounts over here, but how much balance they were having? $100, zero, $50. What was it? All the money, what they have done, they have taken it from the Switzerland to Cyprus. And Cyprus was NJ. So Cyprus will not share the information with us. I'm actually giving you the history. So Cyprus will not give the information. So what these people have done is they have actually moved all their black money to Cyprus. Correct. Now, what they will do, they want to bring back this money. Obviously, in India, they would like to bring back this money in India. So how they will bring? They will see what will happen is they will open an account in Cyprus. Let's say a very rich assessee, a very corrupt person in India. He has so much of black money. He has deposited in the Swiss account. Once we get the DTA with Switzerland, then he's transferred his money to Cyprus. And let's say, for example, in a bank of Cyprus, he opened an account and he deposited millions of dollars over here. Okay. Then what he did is he has taken a loan from this bank. So let's say, for example, $100 million he has deposited over here, and now he has taken the loan also from that. So why Cyprus bank will give him a loan? Obviously, he has actually what he did is he deposited the money over there. So what section 94A says that whenever you will transact with any person who is located in NJ, so whenever the taxpayer, the assessee, if you do any type of transaction with the person who are located in NJ, we will treat them as your associated enterprises. So we will treat them as your associated enterprises. And if we will treat them as your associated enterprises, so it means the transactions which you are doing will be considered as international transactions, and we will apply ALP over here. And we will apply ALP. So even that person is, you are not holding, let's say any one of them is not holding 26% or more shares, no management, nothing. But still, we will consider each person with whom you are transacting. If that person is located in NJ, we will treat it as an associated enterprises. We will treat that transaction as an international transaction, and we will actually apply transfer pricing provision on that. And secondly, that relaxation which we used to give you, 3% or 1%, that relaxation also we will not give. Got it? First thing. Then the second thing is that if you transact with them, let's say, for example, this is Mr. A. He is in India. And let's say, for example, if you have taken a loan from this bank, which is in Cyprus, let's say, for example, you have taken a loan of rupees, let's say, for example, 50 crores. You have taken a loan of 50 crores. Now, whatever the interest you are paying, we will disallow it. We will disallow it if the person who has given you the loan will not give us the source, that why he has given this loan, why this Cyprus bank has to Mr. A who is in India, why the Cyprus bank has given a loan of 50 crores. What was the guarantee? Who has given the guarantee of this loan? There must be any security deposit. So Cyprus bank has to give the information to the Indian income tax authorities. And obviously Cyprus will not share the information with us. So what he has to do, Mr. A, you have to give the power of attorney of this bank to us. You have to give that powers which you have to give this power to us, so that we can actually ask them for the information, and they have to provide us the information. And if they provide us the information, and if we find that yes, the information is genuine, then we will allow that expense to you. Or if whatever the interest you are paying, any other expense which you are incurring for that, we will not allow that expense. First thing, right? Unless and until you give us the power of attorney and to determine, so that we can check that what is the source of this money which is coming from. Correct. Second thing, whatever the tax rate, whatever the amount you are paying to them, whatever the amount, let's say for example, you are paying interest to them, then we will deduct TDS. We will deduct TDS on it. And what would it, this is very important. What would be the TDS rate? Three things: A, B, C. The TDS rate would be whatever is the TDS rate in the applicable section. For example, it is interest, royalty, etc., where the TDS rate is 10%, let's say. So whatever is the TDS rate, we will apply that, or the rate in force. The rate in force. What is rate in force? Rate in force means, let's say for example, you are paying to someone who is a company. So what would be the rate for that? What is the rate for the foreign company? 35%. So the rate in force 35% or 30%. 30% is the fixed amount, whichever is higher. So let's say for example, that income is taxable at 10% rate. Let's say for example, that income is taxable at 10% rate. Let's say the TDS also which you are paying to that non-resident, the person who is sitting in Cyprus, you are paying to them, let's say for example, interest, and interest is taxable at 10% only, and the TDS is also 10%, but we will not deduct TDS 10%. What we will deduct? The TDS which is applicable in that particular section, or the rate which is in force. For example, you are dealing with some individual, so what is the rate in force? The slab rate, or 30%, whichever is higher. Understood? So this would be the TDS rate. Correct? Now, if you will not declare, if you will not be able to justify the source, then we will not allow any expense to you. Now people will say, okay, don't allow the expense. Don't allow the expense. At least he has brought the money now. So he is more concerned with bringing the money in India. So he said, don't allow the expense. They will say, no, we will not stop over here. If you don't give the source, if we don't get this justification from that person who is sitting in NJA, if we will not get the justification from that person, whatever the money which you have brought into India, we will consider as your income, because it is actually his income only, but it was his black money. So they are saying that we will consider this as your income. So there is such a beautiful law they have made to curb this practice. So what will happen is, now any person who is sitting, now let me summarize this section for you. This is the overview, guys. Let me summarize this section. Section 94A is NJ. What is NJ? It is a country or a territory which the government of India can declare that as an NJ. Why? Generally, they don't share information with us. So we can consider them an NJ. At present, there is no NJ, but earlier there used to be one, Cyprus, but again, they have apologized it. So we have taken that status away from them. So as of now, there is no NJ. Now, if you do any type of transaction with a person who is there in NJ, who is there in NJ? Let's say, for example, you are doing a transaction with an individual. So an individual who is a resident of that NJ, that person would be an associated person. Or let's say there is any company which is established, which is registered in NJ, that is also a person which is located in NJ. Or let's say, for example, there is any foreign company. For example, there is a company in US, but they have a PE in NJ. For example, they have a PE in Cyprus. So that PE. So if any person, you will transact with such individual who is a resident of that NJ, or if you transact with any company who are established or registered in NJ like Cyprus, or if you are transacting with any PE who is there established or doing the business in NJ, then these people are always considered as your associated person. And whatever the transaction which you are doing with them, it is considered as an international transaction. Now, what would be the TDS we would be deducting? We would be deducting the TDS rate in force, or 30%, whichever is higher, we will be deducting the TDS. This is an important point. And if you will not give us the authority so that we can examine that what it is, why they have given you this money, then we will disallow this expense. We will disallow this expense. We will not allow you expense. And let's say, for example, you have purchased some assets from NJ or any other expense which you have done, we will not give you any deduction. We will not give you any depreciation. We will not give you any deduction. And moreover, we will not stop over here. If that person is not able to actually give us the source that from where actually he is giving this money, so whatever the money you have actually taken from outside, we will consider this as your income. Got it? So this is the concept of NJA in total. So section 94A says, what is notified jurisdictional area? So central government is empowered. So our government is empowered to notify any country or territory outside India as NJ. So we can notify any country or territory. At present, which one? No one. But earlier it was Cyprus. Having regard to the lack of effective exchange of information, why we consider them NJ? Because they don't share information with us. Person located in NJ would be an individual. So if you transact with any individual who is there in NJ, who is a resident of NJ, so this person is supposed is be deemed as your associated enterprises. Or if you transact with any person other than individual, let's say company. So that company which is registered in NJ, which is registered in, let's say, Cyprus. So any person established in NJ or any PE, let's say there is some foreign company, some other company, but they have their offices in NJ. So that PE, if you are transacting with that PE, which is located in NJ, so these people are considered to be your associated enterprises. They will always be deemed to be your associated enterprises. So what is the consequence of dealing with these persons? They will always be considered as an associated enterprises. Whatever dealings you are doing with them, whatever the transactions which you are doing with them, it is considered as an international transactions. And moreover, the tolerance band of 3% or 1%, as the case may be, will not be available. Got it? So that is the reason I have actually affixed this, that please don't deal with NJ. Otherwise, the consequences would be very, very harsh. So what are the consequences? The TDS rate, this is very important, guys. This is what the examiner will ask you. So the TDS rate will be higher of the following. What it would be? The rate specified in the relevant provision of the Income Tax Act. What is the rate which is mentioned in the relevant section of the TDS? Or the rate or rate in force. For example, you are a foreign company, 35%. Or let's say, for example, you are an individual, then it could be slab rate, which can go as high as 30% or 30%. 30% is a fixed, whichever is higher. This is the TDS rate, right? So I'm not saying that the tax rate will become 30%. No, TDS rate will become 30%. So what will happen? Let's say, for example, we are paying interest to them where it is taxable at a rate of 10%. So now what they will do, we will deduct 30% TDS. So now what they will do, they have to furnish the return in India and then they can claim their refund. Correct. So the class which I was discussing, that I would like to take a separate session for question answer. I would like to take this question. It's a very good question on NJ. So I will take few questions on NJ also in that session. Okay. Let's say fifth point is payment made to any financial institution located in NJ. Let's say, for example, you are making a payment to any bank who is located in NJ. Why you are making a payment? Might be you have taken a loan from them. Why they have given you the loan? So payment made to any financial institution located in NJ would not be allowed as a deduction. We will not allow that interest to you. Why? Unless the assessee authorizes the CBDT. So what the assessee has to do, because they will not give the information directly to the income tax department. So income tax department needs power. So what they will do, the assessee will give the power of attorney to our assessing officer. So this is our assessing officer. He will go and scrutinize it, right? He will not go exactly, but he can actually call for the information. Will not be allowed as deduction unless the assessee authorizes the CBDT. What is this? Power of attorney. Unless the assessee authorizes the CBDT or any other income tax authority, let's say as any assessing officer acting on his behalf, to seek relevant information from the financial institution on the behalf of the assessee, that we will have the same power as that assessee has, so we can take the information from that financial institution. If the assessee will not give us the power of attorney, we will not allow that interest. Second thing, if you have actually incurred some expenses, or let's say, for example, you have purchased some assets from the NJ, we will not give you depreciation also. No deduction in respect of any other expenditure which you are making, or any allowance, including depreciation, arising from the transaction with a person located in NJ. If you have done any transaction with the NJ or any deduction you are claiming here in India, we will not give you deduction unless and until that person explains the source. With a person located in NJ would be allowed unless the assessee maintains the relevant documents and furnishes the prescribed information. Unless and until you give all the information, you actually prove that this is a genuine transaction, till then we will not allow that deduction. People will say, okay, sir, don't allow. We will say, don't allow. But we have a very, very important, a strong weapon. This is very important. Any sum credit, any amount which you have received from NJ. So any sum credit or receipt from a person located in NJ to be deemed to be the income of the recipient, we will actually assume, let's say, for example, if you have taken a loan also from any bank, or you have taken a loan from any person in NJ, see what will happen is, let's say you have a friend in NJ. So what you will do, from your Swiss bank, you will directly transfer the money in Cyprus, and you will ask that friend that please give me this loan, right? So if you will not be able to explain the source of this, then what will happen is, we will actually, whatever the loan which you have taken from your friend now, we will actually deem this it as your income. So any sum credited or received from a person located in NJA to be deemed to be the income of the recipient assessee if he does not explain satisfactorily the source of such money in the hands of such person. So you have to prove that from where that person has got this much of amount. So this is the concept of NJA, guys. Very, very important. I'll be discussing this question in the next session, right? Only that session I'll keep only for question and answer. Okay, let us come to the last concept of transfer pricing, and we are almost done with this. This is the concept of thin capitalization. See what happens is, this is section 94B. 94B. This is that excess interest will not be allowed. Excess interest not allowed. See what happens is, for example, there is in India, Int Limited India, right? Let's say they have an associate enterprise, the parent company is US. So US Incorporation. So what they will do, they will actually, rather than investing equity, they will more and more give money in the form of debt. Rather than investing equity more, what they will do, they will give debt more. Reason being, what is the reason? Guys, because you understand that dividend is not an allowable expense, right? So for example, if these people in US, this company in US, they will give equity in India. And let's say, for example, if we give dividend to them, so dividend is not allowed in India, and India Limited has to pay tax also on it, right? It is dividend. Dividend is not allowed. It will be added back in PGBP, and you have to pay taxes. But interest is allowed, right? Interest is allowed. So they know that interest is allowed. So what they will do, they will actually give more and more debt in India. Excess debt they will give in India, right? They will keep the equity less, but they will increase the debt. So they will give more and more debt in India. Why? Because when we will give the interest to them, so it will be a deductible expense. Let's say, for example, before interest, our net profit is coming as, for example, it is coming as 50 lakh. Our net profit is coming as 50 lakh in India. So what will happen? Not 50 lakh. Let me increase it. Let's say our net profit is coming as 5 crores, right? So what we will do, what they will try to do, because in India the tax rate is higher. So what they will do, they will give so much of debt that these people have to give interest. Sorry, they have to give interest to US Incorporation. How much they will give? They will be giving at highest rate, very, very high rate of interest they will be giving. Let's say, for example, for 4.5 crore they will be giving interest. And how much would be the net profit? It would be left only 50 lakh after giving interest. So this much money they have taken it away from India, and this Indian company has increases their expenses and reduces their profit, and Indian government will lose on it. So Indian government wants that we would like to track this interest. We will allow interest, but not that much that you can pay any amount of interest. No, we will limit it that you can pay interest maximum, the amount which you have paid, actual interest. We will compare this with maximum which we will allow is 30% of EBITDA. That how much interest you can give? Only 30% of your earning before interest, tax, depreciation and amortization, which we call it EBITDA. So you can pay only 30% of EBITDA. Let's say if you have paid 4.5 crore, but 30% of EBITDA comes to, let's say, for example, 2 crores, then 2.5 crore will not be allowed for you. 2.5 crore will not be allowed for you. This concept is known as thin capitalization. Why thin capitalization? Why thin capitalization? Because actually you are investing less of equity and more of debt. You are investing you are investing less of equity, but you are investing more and more debt. So this is the concept of thin capitalization. So the concept of thin capitalization, so people were doing it globally, not only in India they were investing, globally they were doing it. So BEPS again came in with their action plan. They said no. Whatever the interest which we will pay, it will be limited. It will be limited. If it is less than 30% of EBITDA, we are okay. But if it is more, then we will allow only 30% of EBITDA. Right. Now, when this provision came, now these guys are very smart. These guys are very smart. So this US incorporation in US, what they will do, they will say that if we will invest here as a debt, we'll purchase debentures over here, then they will not allow interest more than 30%. So what they will do, they will create a dummy enterprise. They will create a dummy enterprise. For example, they will create ZINC, and through ZINC, they will invest in India. How they will invest? Let's say, for example, now ZINC is investing in India, and who is giving guarantee to it? US Incorporation, right? Or let's say, for example, US Incorporation has deposited a similar amount here. Let's say, for example, 20 crores they have invested it over here, and they are asking ZINC that please give 20 crores to them as debt, right? So if we will see that either associate enterprises, you are giving too much debt, and where you are actually getting too much of interest, or any other person which is not related, but actually you are behind him, you are either giving guarantee to it, or you have invested a similar amount in them. And if we find that this is happening, we'll apply the provisions of 94B, and maximum interest which we will allow is 30% of EBITDA. If you have paid less, then it's okay, but if you have paid more, then we will not allow more than 30%. Till here, everybody is okay. There are few more things which is there in the section. First of all, let us understand till here. So there is a section 94B, which says limitation of interest deduction, that we will limit that interest. Whatever you are paying to your associate enterprises, we will limit it. The concept is known as thin capitalization. It says multinational groups are often able to structure their financing. How the multinational groups are actually structuring their financing? Less of equity, more of debt. They are structuring their financing arrangements to maximize the tax benefits through intra-group financing. In this manner, the multinational enterprises are able to claim the excessive deduction of interest in the high tax jurisdiction. So let's say India is a high tax jurisdiction. So what they were doing from India, they were actually paying more and more interest and shifting the profit to the low tax jurisdiction, resulting in base erosion and profit shifting, right? So from India, the profits are getting less and less and less. To avoid this base erosion, BEPS section plan number 4 is recommended, and section 94B was, see what was happening, because India is part of OECD. So whatever was happening, India used to incorporate that in the law, in their own country law. So we have inserted section 94B, was introduced in line with the action plan. So what will happen, whether Indian company or PE of a foreign company which is in India, let's say there is a foreign company, we have a PE in India, or let's say an Indian company, is paying any interest or any similar thing like interest, or any similar interest expense we are paying like interest, let's say guarantee commission or any other amount which we are paying, excess interest shall be disallowed if we are paying to our non-resident associated enterprises. And what is non-resident associated enterprises? They have given us the loan, they have actually invested in debentures, etc. Now, how much interest we will allow? Only the maximum 30%. So whatever the interest we have actually paid to them or payable to them, any interest, or it could be any similar expense like guarantee commission or any other expense, or 30% of EBITDA, whichever is lower, only that we will allow. We will not allow you more. Only 30% we will allow. Right. Then what will happen? Let's say, for example, in the first year, for example, the interest which we have paid is 4.5 crores. So actual interest comes to, let's say I'm writing over here, the actual interest comes to, let's say 4.5 crores. Let's say this is the first year, this is previous year, 25-26, right? The actual interest is 4.5 crores. Let's say 30% of EBITDA comes to, let's say for example, 3 crores. So how much interest we will allow? So 4.5 crore we will not allow, we will allow only 3 crores. So whichever is less, 3 crore. So 1.5 crore would be disallowed. Right, 1.5 crore would be disallowed in this year. So in 1 year only we can allow maximum 30%. Now let's say in the second year, let's say in the next year, previous year 26-27. Now the actual interest comes to, let's say 4.5 crores. Still it is again same in the second year, 4.5 crore. But 30% of EBITDA of next year, let's say comes to 30% of EBITDA. So I'm randomly giving you the figure. Let's say it comes to 5 crores. So how much we will allow? Sir, here we are not paying more than 30% in this year. Okay. So 4.5 crore would be allowed, obviously, this year. Now, whatever was disallowed last year, 1.5 crore, was it dead? No, no, no. It will remain alive for next 8 years. It will remain alive for next 8 years. So what will happen? Whenever we are paying actual interest less than 30%. So here, actually in this year, 30% was 5 crore, 4.5 crore we have paid. Still we have the capacity of how much? 50 lakh. So out of this 1.5 crore, 50 lakh will be used over here. Got it? So 50 lakh would be used over here, and the remaining 1 crore can still be carried forward for 7 more years. So total for 8 years we can carry it forward. So this is what it is written over here. Excess interest shall not be allowed. So excess interest in the first year was how much? 4.5 crore was the actual. 30% of EBITDA, let's say it was 3 crore. So 4.5 crore or 3 crore, whichever is lower, 3 crore was allowed. Excess 1.5 crore was disallowed. So excess interest will not be allowed. 1.5 crore we have disallowed. But is it dead? No, it is not dead. What we will do? We will actually can carry it forward in another 8 years. And whenever there is a space, let's say for example, whenever we are paying less than 30%, we can use that carried forward thing over there. So however, can be carried forward for 8 years, and deduction can be allowed from PGBP of those subsequent years. Got it? And this is what we have already discussed. So let's say for example, you are not giving the interest to your direct associated enterprises, but indirectly you are giving to some other unrelated person, but which is actually in the background, your associated enterprise is working on it. So how they are working? Deemed debt by A if the debt is provided by unrelated lender. If any other person has given us the debt, however, why they have given the debt? Because our AE has provided guarantee to them. So this is what I was discussing. So let's say where it was, this one. So let's say US Incorporation is not directly giving the money, but they have actually incorporated some other person. They have created a dummy enterprise and they are giving us the debt. And why they are giving us the debt? Because they have given the guarantee, or let's say for example, they have actually deposited the similar amount with them. So it is saying they are deemed debt by AE. If the debt is provided by unrelated lender, however, A provides guarantee to such lenders. Our AE has actually provided the guarantee to them, or AE has deposited corresponding matching amount with them. Then also we'll assume that as if it is a deemed associated enterprises, and we will allow this provision of 30% of EBITDA maximum. Right? Very, very important. Again, the same thing. 1 crore is repeated here also. So this section will not be applicable if the interest which you are paying outside India to an AE does not exceed rupees 1 crore. So this is very important. If this interest is not exceeding rupees 1 crore, do not apply this 30% provision. Got it? Second thing, see, if the borrower is engaged only and only in the banking business, then see, if we are engaged in the banking business, so it's a normal course of business that we can actually take the money. So if the borrower is engaged in the business of banking or insurance, so if you are a banking company or insurance company, or you are located in IFSC in India and you are a finance company, or NBFC as notified by the central government. Let's say for example, if you are in India and your main business is a banking company, or you are a finance company in IFSC, or you are in NBFC, so it is very, very normal for you. So to them also we will not apply this provision. Understood? The last one. If the lender is, see, I'll explain you this. For example, you are located in India. For example, you have a company A Limited that is in India. For example, it is in Chennai, right? And let's say you have taken a loan. From whom you have taken a loan? Let's say from Bank of America, Chennai branch. Bank of America, Chennai branch. You have taken a loan. And let's say in the normal course of business, you have taken a loan. Why? Let's say, for example, you have taken a loan from Bank of America, Chennai branch, and their parent company is Bank of America, US. Right? So if you have taken a loan, then in a normal course of business from a banking company, then also this section will not apply. So they say that if the lender is a PE in India, PE is India what? For Bank of America, you are actually, this Chennai branch is the PE. And let's say, for example, you are not a very big company. For example, your total assets was, let's say, for example, 5 crore, and you have taken a loan to run your business. You have taken a loan, let's say, for example, 3 crores. So what we will say, oh, you have taken a loan of more than 51%, you will become associate enterprise. But do you think that it is actually an associate enterprise transaction, or it's a normal loan transaction? It's a normal loan transaction. So although they are giving you the loan, and if you will see that it is more than 51%, it is actually how much? 60%. So the assessing officer will say you will become an associate enterprise. The answer is no. If the lender is the P in India, P is what? Bank of America Chennai branch of a non-resident. So of the non-resident, the main parent company was Bank of America US. Being a person engaged in the business of banking, that is from a branch of Bank of America in India, if you take a loan, and let's say, for example, the amount of loan is so much that it is exceeding 51%. So what the assessing officer will say, array, you became the associate enterprise. The answer is no. In that case, 30% provisions would not be applicable. Got it? So I believe that now most of the provisions of the transfer pricing are clear to you, right? So we have done a thorough revision of this. I would like to take one more class on transfer pricing, that is specifically on the question and answer. Please do let me know that which is the next chapter which I should pick it up. So probably I'm thinking of picking up either DTAA or charitable trust. So please let me know we should pick it up, and then we'll take that chapter also. We'll be doing the thorough revision, then the question and answer. So till May 2026 examination, we'll be doing sufficient number of chapters. Right. Thank you so much, guys. Good night and take care.